Good morning, ladies and gentlemen. Good morning, Mr. Vice President. It's always a pleasure to be here and to follow on the tradition of our conference on financial integration organized by the ECB and the European Commission as every year. As you always know, the current global situation presents many challenges, and these challenges make the need for more resilience and more competitiveness of Europe, of course, more needed. The resilience and the competitiveness of Europe can be enhanced certainly by economic and financial integration, because it would develop more risk sharing, enhance growth, meet the daunting challenges that we have in terms of digital economy, climate change and aging population, and of course foster more autonomy of Europe in this very uncertain global landscape. So today, obviously, we focus on financial integration. Our conference will follow the usual format. So first of all, the Vice President will hold the opening speech. After that, we will have a presentation of the report by the Commission and by the ECB. Following that, we have the pleasure to host President Letta, former President of the Italian Republic and President of the Jacques Delors Foundation for a Fireside chat. Then we'll have a coffee break. After that, we will start with the two sessions on that day. The first session is dedicated to pensions. The title is From Pillars to Portfolios, Rethinking Pension for Entrepreneurial Europe. And the second session this afternoon is dedicated to the banking sector. How can a more integrated banking sector enhance the competitiveness of the EU economy? And finally, we will finish the day with a keynote speech by Commissioner Maria Luis Albuquerque. All along the event, and to be interactive, there will be an online poll organized. Philippe is here to explain everything if you need be. So an online poll where you have a series of questions, and we'll analyze the aggregation of your answer at the end of the conference. So without further ado, I will pass the floor to Mr. Vice President. The floor is yours. Thank you. Thank you.
Thank you very much, Gil. Good morning to everyone. It's a real honor to speak to you today on a topic that lies at the core of Europe's economic resilience and future growth, financial integration. In an era of geopolitical fragmentation, technological change and economic uncertainty, ensuring that the European Union's financial system is robust and competitive is not just an economic imperative, it's a necessity. With a well-integrated financial system, the EU can weather external shocks, foster sustainable growth, and strengthen its position in an increasingly competitive global landscape, while also allowing business to access capital more easily, facilitating cross-border investment and providing Europeans with better financial products and services. In short, financial integration is crucial to the prosperity, stability, and competitiveness of the Economic and Monetary Union. The Savings and Investments Union is at the heart of this vision, reflecting the essence of the EU project itself: unity, cooperation, and shared prosperity. Today, I would like to begin by taking stock of the progress that has been made in financial integration before highlighting the reforms, particularly of market integration and supervision, that are now within our reach. I will then outline how we can simplify and strengthen our regulatory framework to support a truly competitive and resilient European financial system. Over the past few years, financial integration in the euro area has advanced significantly, cementing its role as a cornerstone of the EU's economic architecture. ECB indicators show that financial integration is now above the average level since the creation of Economic and Monetary Union. Afterwards, you will have the presentation of the report with all this data. The progress reflects two improvements. First, a lower dispersion in euro area asset price and yield differentials across bond, equity, banking, and money markets. And second, a higher degree of capital allocation and portfolio diversification within the euro area, with cross-border debt activity standing out as a key driver. These positive developments have not only deepened integration, but also strengthened the resilience of these markets. Despite significant progress, the full potential of a deeply integrated financial system has still not been unlocked. Cross-border financing in areas like bank lending and equity markets remains at relatively very low levels. For example, cross-border corporate lending within the euro area account for just 14% of total corporate lending, with equity market integration showing troubling signs of decline since 2022. Foreign direct investment within the euro area has fallen to historical low, shining a light on the structural barriers that still hinder seamless capital flows. These contrasting trends underline the need for target policy interventions to address structural barriers and boost integration in underperforming areas. Equity markets, in particular, warrant immediate attention due to the critical role in fostering innovation, supporting entrepreneurship, and diversifying funding sources for European businesses. The principle that capital follows the real economy underscores the relationship between economic growth and financial integration. To fully reap the benefits of a unified financial system, single market reforms and the saving and investment union must advance together in parallel. If we coordinate our efforts, we can build a resilient and unified financial ecosystem that supports European growth and strengthens the EU's global competitiveness. We now have a key opportunity to further deepen integration. The market integration and supervision package, if adopted, could lay the institutional foundations for a truly integrated market capable of mobilizing investment at the scale Europe needs. There are three features of the package that I want to highlight. First, a genuine single rule book for capital markets. This means further harmonizing rules and transforming provisions from directives into regulations that are, as you know, directly applicable across EU member states. A single rule book strengthens the level playing field, reduces legal uncertainty, and fosters greater consistency. Second, support for a tokenized financial ecosystem. By adapting the distributed ledger technology, DLT, pilot regime, we can facilitate innovation in digital financial services while preserving robust regulatory oversight. Europe should be a place where new technologies can scale up safely and efficiently. And third, a more European supervisory framework. A stronger, more consistent supervision at EU level will enhance the resilience of the system and remove the barriers that still limit cross-border capital market integration. Taken together, these measures are much more than mere technical adjustments. They build the foundations for deeper financial integration and a more dynamic capital market, thereby boosting the EU's competitiveness and strategic autonomy. In today's global environment, it's crucial that this package is implemented swiftly. If European firms are to thrive globally, they need the support of competitive and resilient banks. The euro area banking sector is a cornerstone for Europe's financial stability and economic growth. Competitiveness must go hand in hand with resilience. Both can be achieved by simplifying processes, fostering integration, and enabling economies of scale. Well-integrated markets and increased cross-border consolidation enable banks to diversify, strengthen their business models, and better support the real economy, especially during times of stress. While reforms since the global financial crisis have bolstered banks' resilience, national barriers and market fragmentation are obstacles to fully unlocking the benefits of the single market. The crucial step towards strengthening Europe's competitiveness and deepening financial integration is the completion of a truly single banking market where capital and liquidity can move across borders and all deposits are protected equally. To this end, the banking union should be regarded as a single European jurisdiction by all relevant competent and designated authorities. Moreover, the finalization of a fully fledged European Deposit Insurance Scheme, EDIS, is a pivotal step in advancing the banking union. A robust EDIS will protect deposits equally, enhance financial stability, and facilitate cross-border transactions, fostering a truly unified and resilient financial system. In the same vein, allowing capital and liquidity to flow freely within cross-border banking groups in the banking union would enable resources to be promptly and efficiently transferred within groups, especially in times of stress. Progress on those priorities is essential to reduce fragmentation and create a unified and efficient financial ecosystem that supports Europe's long-term economic growth and prosperity. Deeper financial integration must be built on a foundation of resilience. A sound regulatory framework that ensures the stability of the financial sector is essential for long-term growth, and it can be achieved through simpler and more harmonized rules. The EU's regulatory framework is currently still fragmented across member states, creating inefficiencies and inconsistencies that undermine resilience and competitiveness. This fragmentation restricts the financial sector's ability to support the real economy and limits Europe's potential to act as a unified national financial center. Simplified, harmonized rules are therefore essential to unlock the full benefits of integration. Recognizing this need, in December 2025, the Governing Council endorsed a set of recommendations aimed at simplifying the regulatory, supervisory, and reporting frameworks for banks. Another critical area requiring attention is the growing regulatory gap between banks and non-bank financial institutions. As EU capital markets expand and become increasingly interconnected across borders, the prudential framework must also evolve so that emerging risks to financial stability can be detected and addressed. Adjusting the EU macroprudential framework by developing a complementary macroprudential approach for non-banks alongside macroprudential oversight is therefore essential. But harmonization must go beyond prudential rules. Reducing non-prudential barriers, such as disparities in solvency laws, tax systems, and corporate laws, will further streamline operations and remove obstacles to cross-border activity. These measures are critical to fostering a competitive and resilient financial ecosystem that can finance innovation and growth effectively. By addressing these regulatory gaps and inefficiencies, Europe can create a robust framework that supports financial stability while promoting integration and competitiveness. A united, simplified approach will allow the EU to position itself as a global financial center, reinforcing its strategic autonomy and its ability to adapt to emerging challenges. Let me conclude. By advancing the Savings and Investment Union, considering the Banking Union as a single European jurisdiction, finalizing EDIS, and simplifying our regulatory framework, we can create a dynamic and competitive financial system that supports sustainable growth. Therefore, I call on policymakers and market participants to work together to ensure that Europe remains resilient, unified, and a more independent jurisdiction in the present geopolitical framework. Thank you very much.
Thank you, Luis. Thank you, Vice President, for this enlightening speech. It's time now for a few questions, and if you allow me, having the privilege of sharing this session, I will ask the first question. During your mandate, what has been, in your view, the most positive development in terms of European financial integration?
Well, I think that no, I have some doubts. So I would have liked to have a much more progress there. I think, I think that we made much more progress when I was finance minister than when I was here at the ECB. I have to be honest with you. I think that during my times, because normally Europe, the Union moves in times of crisis. And I remember the debt crisis and the banking crisis, and I think that there the SSM was created, was incorporated, and even the single resolution institution, the single resolution board. I am a little bit disappointed because EDIS has not been completed. If you read, for instance, our report, our reply to the European Commission, because they have made a request in order to have, opinions on the competitiveness of, the banking industry, that, is a report that the Commission is going to release, after summer. We say very clearly there that a fully fledged EDIS is going to be necessary. And secondly, I am much more, on the no positive side than on the positive side. I think that, for us, to make further progress on the single market would have been key. I think that capital flows normally, follow the integration in the goods and services markets. And the obstacles, the difficulties, the lack of harmonization that we have for the single market for goods and services is one of the elements that is limiting, the free flow of capital in a single jurisdiction as this one. Now we are in a different time. I think that it's quite clear that Europe has to become much more independent. We are in a different geopolitical situation. And I hope that policymakers will realize that further integration is going to be key. So it's not time of a debt crisis as the one that we had 15 years ago, but I think that the present geopolitical context really calls for further action. And I hope that policymakers, the Parliament, the Council, the Commission, will realize that further integration is the only way forward.
Thank you, Luis, for this very lucid answer, not fully positive, not fully negative, but I think very realistic answer. Are there questions in the audience, please? I think you can ask questions directly here or online question for people not attending the conference. Philippe has a question.
Yes. I guess we would have one that relates to the strategic autonomy. So what do you think that Europe should and can do actually to advance strategic autonomy and the competitiveness of its financial sector?
Well, strategic autonomy is a polyhedric concept. I think that there are several areas that we need to progress and to make clear, to take clear measures. I think that one of them is defense. Has very little to do with financial integration, but I think that defense is one of the areas. Now, I think that the existential priority of Europe is to try to improve, the defense collectively. Given the geopolitical situation, we have the invasion of Ukraine and the Russian threat, and simultaneously, well, the umbrella and the protection from the US is a little bit fading out. So defense is, in my view, the first element. The second one is energy autonomy. I think that to make progress on the green transition is important, not only for climate, also in order to reduce our dependency from fossil fuels that we have to import, that we do not have in Europe. So it's the combination of these two aspects that, in my view, are relevant. Is climate, and is to become more autonomous and to depend much less from external sources for delivery of energy. The third area, in my view, should be, IT, the technological aspect, the cloud, artificial intelligence. Well, now we have, the debate about mythos, Anthropic, and, the kind of strategic issues that, this situation, this dependency from foreign suppliers of technology could pose for Europe. And finally, for instance, means of payment. So all these are, I think that the digital euro is something that, that is very close to, to the strategic approach of, the ECB and the priorities and the strategic priorities of the ECB. Now, if you look at who are, what's the nationality of the owners of the main means of payment in the euro area in Europe, you will realize that they are, they are not European. They have a different nationality. So it's a polyedric concept, but I think that is the only way forward. And simultaneously, well, with respect going a little bit more to the economics, to the economic and financial space, I think that the single market is key. The single market, to have a real single market for goods and services, in my view, is key. It's very difficult to have integrated capital markets without a real single market for goods and services. The banking union is clear. Well, it has to be delivered. No, there we have a lot of talk and very little walk. Well, if I continue, with, mentioning, things that are vital, in my view, is perhaps, to be more united in terms of a fiscal facility, a common fiscal facility in the euro area. So, the areas of progress are there. I think that we have to be ambitious, but I think that the only alternative is to be independent from a strategic standpoint. And in order to do that, first of all, we have to put, national views, a little bit below the pro-European objectives. But it's not easy. Simultaneously, because I think that one of the problems that we have now is that we have fragmentation not only at the capital level, the capital market level, but as well, at the political level. So it's important that we are a little bit more united. I can say all these things after attending, for instance, the ECOFIN for more than 15 years, and my conviction is that the only way forward, is to have a much more integrated Europe, trying to overcome the political disparities that we have now. If you look at the situation of the European Parliament, it's clear, that well, some of these projects are going to be difficult to be implemented because of the political situation and the landscape there. But I hope that eventually, common sense will prevail.
Thank you. Philippe, do you have any other question in the attendance or online? Let's try. You have the opportunity of having the Vice President, so please ask questions.
Well, thank you. I was wondering, you mentioned EDIS a couple of times. Could you elaborate a little bit more on the factors that are hampering EDIS and maybe solutions that could overcome these? Thank you.
Well, I think that a fully fledged EDIS is key. We need to have, common coverage of deposits all over the union. Well, we started to discuss EDIS, even 12 years ago, and it was a sort of tug of war. Some people say, well, if we want to make progress on EDIS, we need, to reduce, the nexus between sovereigns and banks. I think that now there is a great advantage in comparison with those times, 10, 12 years ago. The great advantage is that the situation of the banking industry in Europe is much better now than it was. Well, I remember, the times at the beginning of the second decade of this century, with the situation and the doubts about the Spanish banks, about the Spanish saving banks, the Italian banks, and the Greek banks. I think that now is, those kind of concerns have started to disappear, and I think that we have a much more homogeneous situation of the banks all over Europe. So theoretically, in principle, this should not give rise, to the kind of discussions that we had 10, 12 years ago. And it should pave the way for, discussing and making progress on EDIS. But we need the political will. I think that to have a much better, a much more homogeneous banking industry, I think that is something that could be positive in terms of paving the way for the discussion in the near future.
Thank you. Philip?
Yes, we would have one more question from the online audience. How can a 28th regime help and boost the single financial market, but also the goods and services market?
Do you refer to the 28th regime?
Yes.
Okay. Well, I think that is one of the alternatives. I think that is an avenue that is worth to explore. I think that's a proposal. At the end of the day, it's going to be a sort of enhanced cooperation. But I think that it could be a way forward. Now, we have to try to put in place different alternatives in order to be more integrated. So I think that it's an alternative that is worth to explore and to navigate. I don't know whether now there is a lot of enthusiasm in the European Commission with respect to the 28th regime. You can ask Commissioner Albuquerque afterwards. But well, we have to use all the available instruments that we have at our disposal in order to make progress. And I think the 28th regime could be one of them. There's another one there.
If you have time, thank you. We hear a lot about the importance of developing European capital markets and also about banking competitiveness. My question is, thank you very much. My question is, could European banks become more competitive if capital markets developed and banks weren't trying to hold up the entire economy to the extent they are today?
Well, I think so. I think that capital markets and and banks they are interconnected, and I think that I fully agree. Sometimes they can say, well, we are going to have more competitors from the capital market space, no? But I think that it's the other way around. I think that they are interconnected. And I think that this is not a zero-sum game. Both of them can make progress. So I think that is going to be key. But I come back to my main point. My main point is that it's very difficult to have capital market integration without a real single market. Now you are going to have Enrico Letta, the former Prime Minister of Italy. I think that his report on the single market is very, very good. And I think that this is the key element in my view, my personal view. And this has to do with something that is not easy because there are some political obstacles, as you know perfectly. For instance, to have a harmonized taxation on savings all over the Union, or the insolvency law. Well, it's something that is delicate, and there is something that is important. Taxation is on the hands of the finance ministers normally, but insolvency laws, for instance, are in the hands of other kind of ministers, and you can have difficulties there. But I think that the key element, in my view, the crucial development in the future will be the single market. Without a real single market for goods and services, it's going to be almost impossible to have, capital market integration.
Last question, maybe. Philippe, do you have a question? Or?
I would have one last question from the online audience. Do you think SIU has potential to reduce EU current account surpluses?
Current account surplus. Well, the current account surplus of the balance of payments, I suppose that he refers to. Well, I think that this is one of the important questions because we have we export capitals overseas as the European Union, as the euro area, because we have a surplus of the current account. So you can approach the current account of the balance of payments from different perspectives. There is, in my view, one that is for capital markets and for financial, from the financial standpoint, I think that is very important. That is, a surplus of the current account of the balance of payment is the consequence of a savings ratio that exceeds the investment ratio of the economy. So, and then, as a consequence, you have to export the excess of savings to the rest of the world. I think that the problem is not the level of savings. even though the level of savings since the pandemic has been quite stable in the euro area. So consumption has not gone up as we have projected for a long period of time. And the savings ratio is quite stable, it's quite high. I think that the real problem is investments. Why the investment ratio in Europe is so low? And here, this connects with the single market, with why, investment projects in Europe are not attractive enough in order to, to focus our savings into these projects. And instead, we have to go overseas to find investment projects that are attractive enough. I think that this is the key point. If the investment ratio goes up and the savings ratio is stable, well, our current account surplus will start to reduce, and the capital exports and capital external flows will start to decline as well.
Thank you very much, Luis. Thank you for this very enlightening discussion. As from your vantage point as former Minister of Finance in Spain and board members, and you supervise all the work at the ECB on financial integration, financial stability. So we're very grateful to have had you for 8 years. It's not finished yet, and to have your view this morning on financial integration. So let me close this session and move to the next session. Thank you, Vice President.
Thank you very much, Gil.
Thank you very much.
Thank you.
I've got the signal to start now, so it's my pleasure to have here two high-level representatives of the ECB and of the Commission. So from the Commission, Mrs. Alexandra Schroeder, Deputy Director General at FISMA at the Commission, and John Fell, Deputy Director General at Financial Stability and Macroprudential Policies at the ECB. So as usual, as we do every year, we'll have a presentation of the respective reports of the Commission and the ECB on financial integration. And I think we start actually with John for his presentation, followed then by some Q&A, and then Mrs. Schroeder, and again a few Q&A. So John, the floor is yours. So I assume everything is ready from a technical perspective. So you can stand there in front of a lectrum. And let's see. Yes, everything seems ready.
Am I waiting for a signal? Good morning, everyone. Some people here will know me from my work on our financial stability review, and that I'm often the bearer of bad news. But today, we're publishing our financial integration and structure in the euro area, our FISIA report. And for me, this time is different. We think we have some good news to share. In a sentence, financial integration in the euro area has improved. That said, and for those who felt that one might be coming, I can confirm that we do have a few buts, and they are important and well known. Europe is still not managing to convert its large savings base into scale, into risk capital, and into cross-border investment as effectively as we think it could. So as everyone here knows well, it's this gap that the Savings and Investment Union, or SIU for short, is aiming to close. So this is our fourth, and I spelled out the acronym once, I won't do it again. This is our fourth FISIA report, and it does two things. First, it takes stock of financial integration and structure using a standard set of indicators that we've been using in our financial integration reports over the years. And second, it looks at practical policy areas where the SIU can make integration more useful for households, for firms, and for markets. Now, the first part of my presentation will be about diagnosis, and it aims to answer questions like how integrated the euro area financial system is, how its structure is changing, and whether the integration that we see today is resilient. So, elaborating on my opening message, both our price-based and our quantity-based composite indicators, you can see them there on the left, they show significant improvement in euro area financial integration. Over the past 2 to 3 years, progress had been disappointing before, and this is why this time is different. So in plain terms, prices across markets have moved more closely together, and cross-border holdings and diversification have increased. Now, the price-based movement is broad, and it's across bond, equity, and banking markets. The caveat, though, is that the money market sub-index covering the unsecured segment has been more volatile. So I think we can safely say that integration has strengthened, and not only in one market segment, but the picture is not perfectly uniform. And I think that echoes what the Vice President was saying in his Q&A. So our second message is more cautious. Since 2003, external financing by firms, by households and governments has weakened. Higher borrowing costs, uncertainty and cautious sentiment have pushed firms and households towards internal resources. So what do we mean by that? Financing themselves out of internally generated cash flow, and also deleveraging. Governments moderated borrowing as fiscal consolidation progressed, as we well know. But there is also an integration angle. Non-domestic intra-euro area providers gained prominence, especially in marketable debt and enlisted shares. So the charts here therefore tell us, I think, two stories at once. Financing needs were subdued, in line also with what the Vice President was saying, but capital market financing became more cross-border within the euro area. So the financial structure itself is also changing. Financial assets as a share of GDP actually declined slightly over the period of review. And of course, the composition shifted as well. I mean, this part is well known. Central banks reduced their share as quantitative easing came to a halt and started reversing, while non-bank financial intermediaries, or NBFIs as they are known for short, gained prominence. So investment funds, insurers, and pension funds have been central to this growth. And that matters because NBFIs can support cross-border risk sharing and market-based finance. But the right-hand side chart adds another, and we have one almost every time, an important caveat. Investment funds allocate around half of their assets, outside the euro area. So on the one hand, and that relates to the very tough question that the Vice President got at the end. So on the one hand, we could see that in a glass half full way as useful diversification, but it also shows that Europe's own capital markets are not yet attractive enough or deep enough to absorb European savings at scale. Now, nearing the end of this segment of my presentation, this slide is the bridge. This slide is the bridge to the policy part. So we also ask in the report whether integration is high quality and whether it's resilient. Equity and longer-term finance are generally more shock absorbing than short-term debt is. It's harder to, I mean, you have to roll over short-term debt. You don't have to with those other instruments. So here the report finds a mixed picture. Debt market integration has improved, supported by a greater willingness of euro area investors to hold longer date bonds from their jurisdictions. But equity market integration has weakened, and intra-euro area foreign direct investment has fallen to historically low levels. And that is why the SIU matters. The challenge that we face is not only to secure more integration, but to secure better integration. What does it take to make the savings and investments unit work? So the question, I think, it's really a practical question. What has to change for Europe savings to finance European investment, innovation, and to scale more effectively? So the SIU chapter is evidence-led rather than impressionistic. And I mean, I think we did some novel things here to prepare it with the support of large language model technology. We collected 172 public commentaries on the SIU, and we extracted from that data 1,292 priority statements. Now, those were classified into 18 priority categories aligned with the Commission's SIU framework. And I think, the findings, I think, were interesting. The highest ranked areas, as you can see there, were supervision, retail participation, cross-border investment, pension systems, post-trading infrastructure, venture and growth capital, and tax barriers, which we actually devote quite a bit of space to in this issue of the review, tax issues. Now, while it was able to do two things that no human or even a small team could ever do in the same amount of time, I think this is not the story in itself, of course. We think the important point here is that the chapter focuses on the issues that market participants are repeatedly identifying as the binding constraints. So, where they think the action really needs to happen. So supervision, as you saw, came out of this exercise as the top ranked priority. And we document a strikingly fragmented landscape. 52 national authorities and 16 institutional setups. And even where EU rules are formally harmonized, supervisory practices and enforcement can differ. So that raises costs for cross-border firms. It weakens the level playing field, and it creates scope for regulatory arbitrage. Now, the policy message here is not that national supervisors should disappear. That's not what we're saying. But rather it is that large cross-border players and inherently cross-border sectors need more integrated EU-level supervision if capital markets are to become genuinely European. Now, tax is the second structural friction, and as I said, we devote a lot of space in the report to this. I just need to get some water, which I didn't have with me. Apologies for that. As I was saying, we devote a lot of space to tax issues, and corporate tax rules, withholding tax procedures, and administrative requirements remain fragmented across the EU. And we're careful here with our language, with our messaging, and we don't pretend that full tax harmonization is around the corner. Instead, we point to some practical steps. FASTER, so the acronym for Faster and Safer Tax Excess Relief, should be transposed into national law by the end of 2028, and it should simplify withholding tax relief. But intra-EU cross-border investment may still remain costlier than domestic investment. So we have box 2 of the report explores an optional harmonized tax area within the EU as a possible way forward. And it starts with willing countries. So this is relating to the question about the 28 regime in a way, starting with willing countries rather than waiting for full unanimity. Now turning to retail participation. I have to sometimes cross-check because my eyesight is not always perfect that I can see. So turning to the retail participation, this is really central because Europe has plenty of savings, but not enough of those savings are reaching productive risk capital. So to give some figures supporting the slogan that you will often see on social media and elsewhere, that Europeans are great savers, but they're not so good at investing. Euro area households had a savings rate, and these are putting figures on what the Vice President was saying as well. Euro area households had a saving rate of 15% in early 2025, and that compares with a significantly lower investment rate of 9%. So hence the current account surplus that he was explaining. Now, at the same time, deposits and currency make up 32% of household portfolios. Now, to put that into perspective, the comparable figure in the US is 11%. And think about it, that's low yielding, interest bearing, and then you kind of wonder why, I think it answers why US savers, actually, US households don't even have to save as much as Euro area savers because they're getting that extra return from investing in higher yielding assets. Now, for direct listed shares, the difference between the average asset portfolio of European and US households, I mean, this is even more striking. They represent just 5%. So this is the amount of households that are holding actual stocks, listed shares individually, not ETFs. So they represent just 5% in Europe. That compares with 31% in the US. So our message is we're not saying that households should be pushed into taking on unsuitable risk. But I think what we are saying is that simple, transparent products, and most importantly, and maybe this is where the US has a bit of an edge, financial literacy or financial awareness or financial information for retail investors, and well-designed incentives can improve long-term returns for savers, and it can also, taken together with some of the tax issues, it could even mean a lower cost of capital for firms. Now, we're coming back to taxes. This slide zooms in on taxation as a barrier to household and institutional investment. Withholding tax procedures differ across member states, and refund systems can be slow. They can be costly, and they can be so complicated that people just literally give up, and they don't bother reclaiming withholding tax, double withholding tax, that they are actually entitled to get back, but because it's so hard with the paperwork, they just don't even try. Now, we cite a figure from the Commission's impact assessment. It's an impact assessment of the cost of inefficient withholding tax procedures. It reaches a figure of about 6.6 billion annually for investors in Europe. Now, that's not just paperwork. It changes behavior. Investors may avoid cross-border holdings because it's just so complicated to, be in Germany and buy a French stock, which, shouldn't be the case. And that, of course, reinforces home bias. Plenty of academic studies on why we have these home biases, and maybe it's not so complicated. Occam's razor. And of course, that weakens capital market integration too. So, we think, and we're big supporters of, we think faster will help, but we're clear in the report that streamlining procedures does not eliminate all of the double taxation frictions. So our overall message on taxation is nuanced. Lower tax rates alone, we don't think This would automatically create deeper capital markets. Several countries with high tax levels they also have highly developed markets. So, I mean, it's not, it's more complicated. There are probably some interaction variables there. What matters is design, simplicity, predictability, relief at source, and savings and investment accounts that are easy to use. Now, I mean, one example that we look at is the Swedish ISK. It's often cited because it combines simplicity, flexibility, and just simply straightforward tax treatment. The safe policy point, I think, here, the one that we're comfortable with, is that tax incentives may help, but they should be designed to bring new savers into the market. We don't think, and we're not pushing to have changes that would merely subsidize existing portfolios. Now, we think one of the most important messages of the report, I just make sure I'm aligned between my slides and my text. One of the most important messages in the report is here. When euro area households do invest in equity, so that's the 5% that are investing in equity, half of their holdings are outside the EU. And US markets are capturing about 34% of that. I mean, that's probably not surprising, not so surprising. Now, we did an exercise. We estimate that aligning EU household deposit ratios with US households could redirect a figure, an astonishingly large figure of 8 trillion euro into long-term market-based investment. Now, we also find a sectoral gap. Euro area households hold about 292 billion euro in EU high-tech sectors. No doubt a big number, but at about 404 billion holdings in US high-tech sectors are even larger. So the bottom line here, I think it's simple. European savings are large, but too little of the risk-based capital is financing Europe's own scale-up and innovation ecosystem aspirations. Now, the next topic from the prioritized list is pensions, and pensions matter because they are long-term savings. Public pensions in Europe, I mean, as everyone knows, are mainly pay-as-you-go, while occupational and private pensions are funded in and they invest in capital markets. Now, the report is explicit that supplementary pensions complement, they don't replace public pensions. It also notes that the prudent person principle is not the problem in itself. The issue is inconsistent and sometimes conservative interpretation across member states. The Commission's package points to clearer rules, pension tracking systems, auto-enrollment, and reforms to IORP and PEPP frameworks as ways to improve retirement outcomes and for mobilizing long-term capital. We also look at private markets in the report, and these remain small compared with public markets and bank lending. This is one of the topics that is in the news almost every day these days, but these markets have grown significantly in recent years. We think that they have a clear role to play in the system, to finance firms that may be too small, that may be too risky, are too intangible heavy. So they don't have assets to bring to a bank when they're looking for a loan. So public markets might be a better place for those kinds of loans than banks. Now, we find that firms that are financed via private markets tend to be more productive, but they also have weaker risk metrics, and maybe you wouldn't be so surprised by that, particularly if they are those intangible backed kind of firms. Now, that's in a way the balance. Private markets can support innovation and they can support SME financing, but transparency, liquidity risks, and some of the issues that are in the FT every day these days, and interlinkages with the wider financial system have become issues, and we do think that they need monitoring. The venture capital market is another area that we looked at. We have a box on this, and I think this part makes the scaling problem that is often talked about very, very concrete. Early stage finance is more available in Europe than late stage scale-up finance. US venture capital firms, VC funds, they amount to about 930 billion. Now again, I mean, it's always the figures are larger for the US compared with around 150 in the US. And US funds invest around 6 times more. Now, ultimately, this affects Europe's IPO, so the initial public offering pipeline and the ability of innovative firms to grow and to reach the point where they want to become listed on a public market. And we often see those really successful firms in Europe going to the US and listing on the New York Stock Exchange or NASDAQ. Now, the point is not simply that Europe needs more venture capital. We think it needs larger funds, deeper exit markets. At the moment where the venture capital investor no longer wants to be invested in the firm and wants to take profits, and the firm goes into an IPO. So we think it needs larger funds and also a less fragmented single market for scaling firms. Now, the investor base also differs sharply when we look at a comparison of VC in Europe compared to the US. In Europe, actually, government entities are actually central to the venture capital ecosystem, or the VC ecosystem. So it's quite different to the US. In the US, it's pension funds and foundations that play a much larger role. Now that means that the European Investment Fund is important as a hub and a credibility signal. But we also say in the report, we warn even that a concentrated network is not a mature private market ecosystem. So the policy implication is that we need to be crowding in more private investors, especially institutional investors, and reduce those cross-border barriers that are currently keeping VC investment networks too national and too narrow. On the regulation of venture capital, we ask whether the available frameworks fit the needs of European venture capital today. So, as an aside, the report is a bit of an alphabet soup of acronyms, but we find that 69% of matched EU VC funds are under the Alternative Investment Fund, or AIF, regime, with about 29% under the European Venture Capital Fund, or EU VECA, V-E-C-A, and 2% under the EU Social Entrepreneurship, another acronym, EU SEF regime. So, I don't know how to say, the Commission colleague could maybe tell us how we say it, but I say EU VECA. It covers a subset of the AIF space, and it's intended to be a lighter regime. But its use varies greatly across countries, and it remains marginal in some large markets. So we think that the upcoming review is an opportunity to make this framework more useful for larger funds and more useful for cross-border scale-up financing. Our post-trade infrastructure, frictions on post-trading infrastructure, frictions can be real issues. If issuance, settlement, asset servicing, laws, all the stuff that takes place in the background for the functioning of markets and also tax processes remain fragmented, then European markets simply become less attractive and less liquid. The EU has made real progress through CSDR and Target 2 Securities, or T2S, the Eurosystem settlement platform, but cross-CSD settlement remains limited, and national legal and tax differences still matter. So I mean, here the Commission's market integration package and work on innovation, we think it can help, but a fully integrated landscape still requires tackling persistent fragmentation. Last but not least, and I hope I just check my alignment. Yeah, last but not least, on distributed ledger technology, or DLT. This is best explained as infrastructure for recording and for transferring tokenized financial assets. Here we say that around 2 billion of euro-denominated debt instruments with digital exposure were outstanding at end 2025. The Eurosystem's 2024 exploratory work tested central bank money settlement for DLT-based wholesale transactions. Nearly 1.6 billion euro in settlement, 64 participants, 9 jurisdictions and 58 distinct use cases. Now, Pontes is the short-term bridge between market DLT platforms and target services with a pilot from the third quarter of 2026. Appia is the longer-term blueprint for an integrated digital ecosystem by 2028. Now, there's also a monetary policy implementation angle in the report too for DLT. Since the 30th of March, the Eurosystem has been accepting marketable assets issued in CSDs using DLT-based services as eligible collateral, provided that they meet the Eurosystem collateral framework requirements and are available for settlement in T2S compatible form. The report also says that the Eurosystem is exploring how assets exclusively settled on DLT networks could become eligible in the future. So I think the message we have here is guidance, not hype. The Eurosystem is giving market participants a common framework while preserving adequacy, safety, efficiency, and a level playing field. Before I say thank you, let me close with 3 takeaways. First, financial integration in the euro area, as I said at the beginning, has improved, and we think this is good news. Second, the quality of integration remains uneven. Debt markets look stronger while equity, FDI, and scale-up financing all remain weaker than we think Europe needs and what Europe needs now. Third, the SIU agenda is about converting Europe's savings into investment capacity by removing a very long list of practical frictions. Now, we find them, I mean, I just went through it, we find them in supervision, we find them in taxation, in retail participation in pensions, venture capital, and also market infrastructure. So there's a lot to do. So we don't think, and I think this was the background of what the Vice President was saying in answering your first question, Gilles. We don't think the report is just a dashboard, though. I mean, so the aim, why do we publish this report at all? I think it's to offer a guide on where we think progress can turn integration into scale and savings into productive investment. And now I say thank you.
Thank you very much, John, for this very thorough and comprehensive assessment of financial integration. So we have time for a few questions, please. So under the control of Philippe. Okay, we have here someone here, please, and introduce yourself before asking the question.
Okay, so my name is Thorsten Müller. I'm representing EFAS, the European Federation of Financial Analysts. John, thank you very much for the very good presentation indeed. One point I was really missing about European financial integration is the European single access point. There's a lot of public debate. We try to bring down bureaucracy, and right now there's a story that the ESAP is about bureaucracy and we have to stop it. We think that ESAP is not about bureaucracy, it's about structural data, and it's one of the fundamentals of a really integrated savings and investment union. We think that it's important to have structural data for using artificial intelligence efficiently, because artificial intelligence needs precise data. And if we just collect data on PDF documents, that will not work. And further on, we also have to think of the US has been using the EDGAR system for, I think, more than 20 years, and it's still the top system we know. And right now, my concern is that the SAP will be loosened or we will not implement it at all. So can you just give me your view about the European single access point? Thank you.
So look, I'm not an expert on this topic, but I mean, everything that you just said sounded very sensible. I mean, I don't know where it is on our prioritization exercise, Jens. Is it there? You know, but I mean, look, I mean, the only thing I can really say here, because I'm not an expert at all on this topic, is that, you know, data, you said something really important on data. You know, digital data, all of this is the future. So if you've now identified, and you're telling us, and I'm glad you did it because it's going to be on the record now, and maybe you get into, and next year, you're in or next time you're in a higher place in that ranking, which was, you know, a long list of issues. But that sounds like something that we should be, progressing in Europe. So there was nothing that you said that I found that I would find myself instinctively saying no. No. I mean, these kinds of areas are where Europe needs to match, if not exceed, what's happening elsewhere on the planet. You're going to come back on that. Although
no, just
out of PDFs.
Yeah, just one further topic I'd like to cover.
Yeah.
Everybody talks about resilience.
Yeah.
Europe is completely dependent on US data aggregators.
Yeah.
And we need to support the European single access point to become more resilient. That is really key. And so that is a really serious point. And I would be happy to go into more details with other people being in charge, but that is absolutely crucial. Thank you.
Okay, I'm glad you said that, because I mean, and I think it even relates to the point that was made on strategic autonomy earlier. Yes, I mean, this is obviously, I mean, and the Vice President was talking about, you know, mythos and, you know, the concerns around that, but I mean, I think it just again reminds us that, you know, there is this huge dependence on US technology in cyber security. I mean, it's not just, you know, that we all know that we use Microsoft and we use Google and all of that, but I mean, it's just everything. It's everything. You even PDFs. We don't even have a rival PDF, you know, business in Europe. So the US sets the standard, you know, in almost everything in tech, and that, you know, I mean, I was. You know, and why does that matter? I mean, I was doing some comparisons, thinking about, you know, how Europe has kind of fallen behind compared to the US. You know, 25 years ago, Europe was ahead in tech. We had some of the best companies. We had Ericsson, we had Nokia, we had, you know, we were the main sellers of mobile phones in the US. We've forgotten that, but that, you know, that was the situation. So we kind of lost that. Over time, and that's, I think, a reflection of falling behind on some of the technological developments. And I think, thank you for raising the point, and I think we will, you know, you've given us something to dig a bit deeper into, so it's appreciated.
Another question, please, in the room or online? Philippe?
Yes, I think we would have one from the online audience that relates to private markets. So there's the question bit I interpreted that international fora point to the risks of private equity, private debt markets, and here we call for Europe to develop actually private markets. Could you please clarify how these two things go together?
Yeah, so that may sound a bit schizophrenic, but it's not. And in fact, we will. I mean, of course, we are part of those debates, those discussions at International Forum. We will have something a bit deeper in the next issue of the Financial Stability Review on private credit, in particular, you know, to try and reconcile the two. I mean, we think, I mean, as I said in the presentation, there is a gap in finance that private credit can fill. Now, but I think when we're talking about private credit, we really kind of have in mind what I would call plain vanilla private credit. So that's really where there is long-term lending to firms. It's not all this additional layer of BDC and all of this that create kind of the vulnerabilities of the kind that we saw in 2008. That part, but that part is much smaller, and that is where I think concerns have started to grow because of retail participation in private credit and so on, and its ability to create products that retail can access. But when you, I mean, we will have this, but in the report. But when you have, when you compare the situation of today with the situation that preceded the global financial crisis, people love to quote the figure. Oh, look, private credit is now today, in nominal terms, just as big as it was, as subprime was back in 2006. I think the figure is almost exactly the same. It's around 1.4 trillion, so it's a great thing. Of course, GDP has grown in the US in the meantime, and that's kind of, it's benefited from the denominator squashing the numerator, and we've got a lower fraction of savings. But the point is, I mean, in particular, the vulnerabilities that we found that were really important in the global financial crisis that caused everything to collapse were what I would call maturity transformation, funding long-term assets with short-term liabilities. That we don't see that in private credit. In fact, there's almost, there's a perfect, there's a perfect correspondence. People can't get their money back. You see this about redemptions now, but this is more about the kind of the marketable side of it. The second point is leverage. Leverage is much lower in private credit than it is in banks. And in many cases, it's like a deal is 50-50 credit and equity. So it's a much lower ratio. So you don't have that kind of, leverage creates a potential for an amplification mechanism. And then there is interconnection. Which is a third big discovery from the global financial crisis. We had this too big to fail before the GFC, then it became too interconnected to fail. There is interconnection, but it's largely with the more long-term parts of the market, and this is where of the financial structure. So particularly with insurance, but also pensions, and these firms, they create assets that are attractive to long-term investors like pension funds, and this is why, if it's managed well, it can be a win-win. But there's lots of intransparency. It's a private market, so they don't have to disclose what they're doing. They're not obliged, but all kinds of issues. And of course now, and I think what has kind of a bit caused the panic is that people are beginning to see that AI is real and that it's having an impact on, it's disrupting businesses. It's disrupting software businesses in particular because, you can just sit, with your, take Claude out and say, write me a software for, I don't know, this, and then you don't need to. But this is why you see it. And that private credit is highly exposed to this sector. So I think that's one of the chief concerns. But I mean, overall, we don't see it on the same magnitude as 2008. I hope that answers the question.
I see time is running, so now I will pass the floor to Alexandra, please. You can join the lectern for the presentation of the Commission report, please. Thanks.
So, ladies and gentlemen, very good morning. Very happy to be in Frankfurt today. And today is also an important day for us because we are presenting our European Commission Financial Stability and Integration Report 2026. But before I come to that, I wanted to start by thanking the ECB this time. hosting in 26 this joint conference on European financial integration. I think it has become what I would call a good tradition. And I think it's really nice that we do this together, Commission and the ECB. And it's also always a very good opportunity to see where do we stand when it comes to recent economic and financial developments. And actually, there are quite a lot happening, and I will come to that in a second. I want also to thank John for his very insightful presentation, also to explaining the SIU matrix so well, so very well done. And for me is now to share with you the findings, give you a sneak preview, as I may call it, on our financial integration report. And I was asking some time ago my colleagues, why are we doing this report? Because there are so many reports, and is there really a need to have this FC report every day? But I think my answer is clear. It's a clear yes, because we think this report helps us a lot to inform policy discussions, especially about recent trends, but also to give a bit the bigger picture. It also allows us to highlight very specific topics that are in the focus of financial integration. And I hope it will also help to raise policy considerations that are relevant for financial services. So in sum, we really think that our report contributes very much to what I would call evidence-based policy making, which is very important. Also, to be very honest with you, I found it sometimes not so easy to do this report in springtime, doing a solid analysis that also covers the most recent developments. We are quite used to this now because we have managed quite some challenges. We had the COVID times that came also somehow as a surprise in 2020. Then, of course, very sadly, Russia's war of aggression against Ukraine 4 years ago. And these were always developments that, of course, had an influence on financial developments and economic developments. Actually, last year in December, I thought it will be different. We will sail into calm waters. But not so really this is the case, because, again, the preparation of this year's report forced us to navigate through what I would call fast-moving geopolitical tensions and quite a lot of uncertainties, in particular, but not only the US trade policy developments we also see coming back in the last days. But nevertheless, and taking all these developments into account, I'm convinced that the 2026 edition will be an interesting reading that will not only focus on events that sometimes change by the day, but allow all of us to grasp the bigger picture, while being, of course, mindful of the ongoing instability associated with recent trends. As time is rather short and you should have still an incentive to read the report, let me limit my intervention to some aspects I found very, very interesting. And of course, the report starts as usual with our overview of economic and financial developments over the last year, but this year we have chosen two specific topics we find of relevance. And the first is about financial conditions of non-financial corporations in the EU. Why did we select this topic? Because we think it is important in view of our policy agenda on promoting better finance for firms, especially as part of our competitive agenda to support growth and jobs in the European Union. And the second chapter, and there have already been some remarks on this morning, and we will follow this up in a panel, is a topic of equally pressing relevance. This is about to see how the funded supplementary pension landscape in the EU can be developed, can be improved, and there are various reasons for that, but we leave that for the panel later on. and where I think we will have a lot of important insights. Very briefly, a few comments on the EU economy. You see it already on the screen, where I think John already gave us a very good overview about the situation on financial integration, and I would agree there is also some positive news in this. And what we did from our side, we looked into the report from the previous year, 2025, but we have also taken into account the first quarter of 2026. And as I was already hinting to at the beginning of 2026, the macroeconomic outlook appeared favorable, with the EU achieving real GDP growth of 1.6% in 2025. And it was also good to see that this trend was supported by very robust wage growth and supportive financing conditions. However, as I said, we are now sailing in a bit more rougher waters, especially looking in the conflict in the Middle East and the subsequent energy price surge. And I think we have to be honest here that this has disrupted, at least for now, this positive trend. And of course, we will getting more intelligent by the day, but it is clear that the magnitude of the shock we now see will certainly depend on two main issues. How long will it take? How long will the conflict last? And what would be or not the extent of supply disruptions? But let's also stay positive this morning. But what is, of course, also very clear from the report that to strive in today's very complex and challenging global environment, the EU economy must bolster its resilient and indeed strategic autonomy. Vice President was already very clear this morning on that. And we also need to do much more to unlock our growth potential, because it's there, but it is remaining in the potential stage. So there is a lot to do, and this will necessitate a meaningful process and progress, especially on our competitive agenda, which is very urgent, but also about the successful and the swift implementation of the Savings and Investment Union. It should be swift, but it should also remain ambitious. Let's have a quick look in the risk to financial stability and financial integration trends, still our chapter 1. Here my message to you this morning is that risks to financial stability remain high in our view, and of course have been intensified with the Middle East conflict. Among key concerns in this area is the potential for disorderly market correction, and we see this still as a major financial stability risk due to consistently low premiums in several risk assets and valuations that are susceptible to a sudden shift in market expectations. Another issue of concern is that we still see high public debt levels in several EU member states. That continues to be a significant issue. And two key developments here have escalated these concerns. First, the need for increased defense spending, which is absolutely necessary, as was already said this morning, but that has, of course, put quite considerable additional pressure on public spending. And second, again, the conflict in the Middle East is having a negative effect on economic growth, spending needs, and borrowing costs. And all these developments can have spillover effects where repricing of sovereign risk could affect the corporate and financial sectors via higher funding costs and rating downgrades. A few small words on the banking sector. Again, maybe starting with some good news. Short-term profitability looks favorable. The sector shows resilience, we can see that, but here again, potential risks to asset quality and funding liquidity. And indeed, there is the issue we were just quickly touching about maybe more increasing interconnections with NBFI, non-bank financial intermediary entities that may expose banks to heightened credit, market liquidity, and operational risks. But again, to try to stay positive this morning, I think it is fair to say, and the report is very clear on that, that indeed the euro area financial integration has strengthened in 2025. And then we will see what 2026 brings us, including geopolitical developments. And I think John has been so very clear on that, that there's not much for me to add. Let me look briefly and give you some ideas what are in the other two chapters on first financial conditions and then on the pensions side. On the conditions of non-financial corporates in the EU, we have basically looked in the report at the financial resilience of these companies, their funding structures, and of course also very important, the access to finance conditions. And here we have come to the conclusion that compared to their counterparts in the UK and the United States, EU non-financial corporates continue to rely significantly less on market funding. That is not a big surprise, but always good to have also some figures to support the message. And the report comes to the conclusion that only 70% of their funding today comes from market sources versus 38% in the UK and 44% in the United States. Domestic bank lending remains a dominant source of debt financing for EU non-financial corporates. And it is also important to say that the share of domestic bank lending has declined since the financial crisis, but it has somehow stabilized in recent years at around 46% of total debt financing. The dominant position of domestic bank lenders in funding non-financial corporations is certainly one of the factors behind the relatively low volume of startups and scale-up funding in the EU we desperately need. And there are a number of good reasons behind banks' hesitation to lend more to innovative business. But it is, of course, clear that the availability of startup and scale-up funding is an area where we lag behind in the European Union, and we really need to see and to make progress to foster a more supportive environment, especially in this area for our business growth and access to finance. And we have done that, and I will be rather short because John has so well explained the saving and investment union ideas. But this is basically our blueprint where we are taking measures to facilitate access to finance and allow firms to diversify funding sources. And this is a missed package. The Vice President was already speaking about. This is a retail saving account. We will have to do much more on financial literacy. And I can already announce, as we were speaking about venture capital and growth funds, that we will come soon with a proposal that somehow addresses this imbalance about the regime we indeed find not longer up to the current challenges we have. It has been done in different times. So the proposal will come as we have it announced in our SIU strategy in March. My last point is on the future pensions landscape. In here again, maybe I'm not too long because we will have in a few minutes the opportunity to discuss this with very high regarded experts. But I think I wanted to leave with you this morning here that we have chosen this topic for the 2026 report because we think it is a very pressing issue. And it's a pressing issue from various angles. I mean, first of all, I think there is indeed a necessity to see how funded or asset-backed pensions can help retirees' financial security and also to allow them to have an adequate standard of living after a long period of hard work and now for their retirement. And at the same time, they reduce pressure on state budgets and would, of course, and that is the other win-win element I see here, channel long-term savings into productive investments where money is really needed. I think we have to be honest, looking into the situation in the EU, and it's very different when you look into the member states' situation, the comparison, but it's a fact that pension assets remain modest and lag far behind our global peers. Again, I mean, if you look at the United States, but also in Canada, with large amounts and EU total pension assets around 32% of GDP. Of course, we have to be mindful that this is partly due to the structure of the European Union. We have a very heterogeneous landscape and pension assets very strongly across member states. But all in all, even if you say there are some member states who are better or doing differently than others, it is a true fact that the EU's pension asset base remain rather underdeveloped, and there are a number of reasons for that we will discuss in a few minutes. But one of the reasons, in our view, is clearly that there is still a very strong reliance on pay-as-you-go public pensions. This is the prerogative of the member states, but it would not mean that we should not look in the EU in ways how we can top up this pay-as-you-go pensions also by private elements. Some member states are doing better, and I think for others there is still a way to go. But maybe also in the interest of time, I leave this for our panel discussion. But what is certainly clear for us is that scale here again and equity investments are key factors to the growth of pension funds we need in the European Union. And for that, we have also done a number of key initiatives. We look in the regulation of the personal pension product, which didn't have a very, I would say, successful uptake, and also in the regime for occupational retirement pension systems. And again, we will come to that in a few minutes. But I wanted to close my presentation also with one important message. I have to say I'm possibly repeating to a large extent what the Vice President was saying this morning, but honestly I think we cannot repeat it often enough. And this is basically that many of the findings you will find in our report confirm for us a very clear need for acting on all levels to unlock the potential of our internal market, from tackling the barriers that really still stand today in the way of a truly integrated capital markets, but also the need to improve conditions for investment and to ensure more sustainable saving and pension solutions for our citizens who really deserve that. So with that, I close my sneak preview. I encourage you to read the report. It should be online by now. And I hope also it brings some interesting elements for all of you, wherever you work. And with that, thank you very much again for your attention. And I give the floor back to the moderator. Thank you.
Thank you, Alexandra. I suggest we take one or two questions, not to drift too much from the time we have, but we still have time for one or two questions. Attendance raised. Philippe?
We would have one from the online audience. It's about the SIU, which has the aim to provide more productive investments, but research shows that listed companies reduce R&D to prioritize shareholder payouts. So maybe to provide your views on how this could be overcome, that more productive investment nevertheless takes place.
This is about what exactly? About
the SIU, and that it should lead to more productive investments.
Okay, I mean, I could speak an hour on that. But I think what is important to foster productive investment in the SIU, this is a collection of various measures looking at the offer side, the demand side, and that we overcome the many structural barriers we still see here. And again, I mean, this is easy to say and not easy to do because it is often also grown over many years from special national situations. I think what we really need here is a bit of disruption, what was just saying on AI, in the way that we cannot continue if we really want to play a role as the EU in the global scene, but also for our citizens and for our economy. If we do this, okay, it somehow has always worked. We do a bit of fine-tuning here and there. Basically, in the end, we have a system that manifests what's already existing in the EU. Member states have to take their responsibility now. We have made a proposal that is subject to discussion, but we really need a big step, and we really also have to overcome national sensitivities in a way. Let's do this together as a European Union.
Any other question? One question here, please, sir.
You focused very much on bringing retail investors to the market. I fully support that. But when we look at another very important investors group, that's the insurance industry. And if you look at the life insurance industry with very long durations, that is an ideal equity investor. And when you look at the numbers, back some 20 years ago, the equity investment ratio of the life insurance industry in Europe was about 20%. Now it's down to 5%. Why does nobody talk about bringing the insurance industry back into equity markets? Thank you.
No, I think you have an important point, and I would not say that nobody speaks about that. I think the reason was basically that there was still very much the concern after we had the financial crisis that investment in equity can of course bring good returns, but it also comes with a risk, and therefore in the long-term perspective and also taking into account that this is policyholders' money, the approach was more conservative. Honestly, I think what we have now done with the Solvency II review that will enter into force early next year, there is already a shift, and some may even feel that we are becoming too risk-friendly because especially on the possibility to invest in equity, the Solvency II review foresees some alleviations without completely putting the boat upside down. But I think it's exactly for the reason you were referring to, that a good, let's say, monitored risk is useful in especially using the money as insurers for life with a long-term perspective to bring especially the volume also they master into this situation. So let's see how it goes. But I think what the approach we have taken, there are deviations from perhaps a bit overly conservative to having a good risk and opportunities balanced approach.
Thank you, Alexandra. I think we will stop here to keep time. So thank you to Alexandra and John for these two presentations of the two reports. I advise you to read these reports, obviously. So we have a coffee break of 15 minutes. And then, as announced previously, we have the Fireside chat with Enrico Letta. We have the honor of having Enrico Letta here. And Rebecca will act as the moderator. So thank you again on this session. And let's have a break for 15 minutes. Thank you.
everybody. Hi, people online. Welcome back to the joint conference of the European Commission and the European Central Bank. I'm Rebecca Christie, and from Brussels, I represent Bruegel, the international economics think tank, here with Enrico Latta, whose accomplishments are legion. But here in particular, we're going to talk about the amazing report on the single market that you did a couple of years ago, which I have been saying consistently is going to be a reference book used for policymakers for years. And what I love about your report is that any new politician can come in, take it off the shelf, flip through and find something and say, oh, that, I need a European project, I'll do that one. And it's such a great reference. So I guess my first question to you is, in the 2 years since your report came out and Draghi's report came out and other reports came out, have we made any progress?
We started having progress in some fields. The one we are discussing here is maybe the most important one. But I have to say that there's an acceleration I see an acceleration in the last 3 months. An acceleration in the last 3 months, I think, is related to what is happening around us, around Europe. And we have to, I would say, take advantage of all these pressures. But my answer is yes, I see an acceleration in the last 3 months. And the most important point for me is the common decision that the three institutions, the Commission, the Council, and the Parliament took 10 days ago in Cyprus, when they decided to have a joint declaration on a roadmap. A joint declaration for me is very important because it was exactly what I asked the leaders in Aldenbiesen when we had the retreat with Draghi too. And I asked them, you can't have an act unique as we did in the 80s and 90s because there are no treaty changes. But you need to try to, I would say, upgrade the level of the different legislative interventions and to create a package. Otherwise, we continue fragmented on different tracks without having in mind the big picture. And the big picture for me is fundamental. And the package logic is also fundamental to have countries on board, political parties on board, stakeholders on board, because with the package, you have someone looking for something inside the package, and it's easier to have les arbitrages. That is fundamental in European negotiations.
So, speaking of national arbitrage from the different rules in one country to another, what about the efforts to integrate financial supervision? It's something that the Commission has put forward a good proposal, the ECB has put forward a supportive opinion, the industry has been fairly supportive, and yet, politically, it looks like it's going to be a very difficult road.
It is clear that this is the crucial political complicated issue because of differences among the member states and because is the consequence of 30 years of non-integration of the financial markets, if I may say. The consequence is that we have some, I would say, situations that were de facto situations. There are de facto situations in which, because of the lack of integration, you had some countries taking the lead, countries that are not very big countries in dimensions, if I may say. And these countries took the lead on some of these and taking advantage of the lack of integration. So today, and this is the multiplication of all the usual difficulties we have in Europe to integrate that are related to the dimension and the fragmentation of legacies. I think the main problem we have in Europe, that is our strength, is that we build always on legacies, existing legacies. And we have existing legacies, and to try to, I would say, to merge, to consolidate, to put together existing legacies is always very complicated because all the ones that are owners of these legacies are resisting. They want to keep the legacy for them. And this topic is clear. I think we need to At the end of the day, it will be necessary to have some creative compromises on that. And that is typical of Europe. We need to stop the clock one night in a closed doors meeting, and then they have to exit with a solution, maybe creative solution, but step forward in comparison with the present situation, because it is clear that the present situation with 27 authorities is one of the most important problems. And also the sense of the message is fundamental. Give to the rest of the world, we are working with one integrated system, as we do here. I'm very happy to say that here from the ECB headquarters, because at the end of the day, the ECB is the same. When we started with the euro, the main problem was, I remember very well, I was a student at that time. The main problem of the creation of the euro was where is the place, the physical place of the central bank. And the fact that the physical place of the central bank was in Germany was the most important political issue. Today is not an issue at all. I have to say, nobody thinks that there's a problem because it's in Frankfurt, in Germany. But I remember 30 years ago, 35 years ago, it was the problem. So the creativity at that time was the creativity to say, we have Frankfurt, and we create a link between Frankfurt and the 11, 12 at that time, and then 21 today, national central banks. They have a role, they have visibility towards their national audiences, but at the same time is here that we decide all together. So I think we have to invent something similar, but we have to present it to the general audience at world level to say, hey, we are going in the right direction. And we have to use everything we can to upgrade also the level of knowledge, awareness about the topic that we are discussing here today, SIU, Savings and Investments Union. I can tell you all the details on the nights in which we decided the name, April 24, SIU. But what I would like to say today, I'm sorry if I was putting down the level of the discussion, but I think it's very important. If you ask AI what SIU is, AI will answer SIU is linked not to a great Portuguese, but not Albuquerque, but Cristiano Ronaldo. Because SIU is the way of Cristiano Ronaldo celebrating his goals. And you have 99% of references of SIU to Cristiano Ronaldo, not to Albuquerque. So it's the wrong Portuguese. So I think we have to start from that, considering that if SIU remains here in these rooms, we are dead. SIU has to become a great political message, as the euro was a great political message. If we are not able to make possible that in 2 years' time, SIU for AI is also Albuquerque, is also Savings and Investments Union, not only Cristiano Ronaldo, I think everything will be lost. If we are able to go in that direction, I think we can be successful.
So Savings and Investment Union is including not only the Capital Markets Union, but also the Banking Union, which, as you point out, has been consolidated supervisory here in Frankfurt, along with monetary policy. But we haven't seen the industry follow the same cross-border model. How can we get more cross-border banking and maybe cross-border mergers in the European banking system?
I think it is the same discourse of the visibility of Savings and Investments Union. I come back to the meeting we had with the leaders. They invited us. I was with Draghi one day with them. And what we asked them was to take the leadership of this exercise saying very clearly that the main example of consolidation and mergers at European level was not a market outcome. Airbus was not a market outcome. It was a political engagement. Countries that decided that we needed to scale. And scaling is absolutely fundamental. Today, it was one of the topics of the two. Congratulations for the presentations. I liked very much. And the topic of scale is absolutely clear. It's fundamental. But to get the result is not just a market. Why? Because the institutional architecture we have is against scale. It is national. We protect national champions. We protect national champions every day. We fight every day with the rules we have against consolidation, European champions. Sorry if I put down once again, but for my professional academic reasons, I rent an apartment in a big European capital. We negotiate everything for the change of the energy in this apartment, call center, everything very effective. The call center at the end asked me two final informations to complete the dossier. Bank account number and please your telephone number. I give my bank account number, I give my telephone number, and the call center silent. And I ask him, is everything okay? I'm sorry, what is this IT at the beginning of the bank account number? I don't recognize it. And what is this plus 39 in your telephone number? I need, and I don't tell you which is the country that is involved. Otherwise, it's, I confess that my first temptation was to say, please, I send you my report on the single market because it can show that I have a constitutional right to have energy in this country, even if with a bank account in Italy or a telephone number in Italy. What was the conclusion? I bought another telephone and I opened another bank account. That was the third because I am also activities in another country in Europe. So 3 bank accounts, 3 telephone numbers, only because we have systems, the present systems, are protecting the national champions. And we are organized by protecting national champions. We say we have the roaming. I'm very happy with the roaming, but try to live in another country, without a telephone number of the country. It's impossible. So this is why I say, answering your question, the point is political. And this is why I told the leaders, if you are not able to move and to break the ice of all this mess, it will be impossible because it's not, the markets are not able to break these, I would say, ceilings that are political ceilings at the end of the day. We organized it, and now we have to break it.
So SIU is on all of the 10-point plans. The leaders repeatedly invoke it in their conclusions. But every time they do a dedicated summit on this, there's a war or an oil crisis. So how do we get them to do this?
I think we have to link to the war. It's very simple, as simple as that. If we don't, we are not able to upgrade the level of visibility of what we are doing. So it is very simple. What I think it is fundamental is to link everything we are doing on the integration of single market to security, to independence, to strategic autonomy, to the fact that we, as Europeans, we have so many threats today, challenges, pressures from abroad, that it is clear that we have to build up our own security strategy, strategic autonomy, ideas and path, and so on. And this is part of that, but for a very simple reason. If we are not able to scale on the financial markets, the power of Europe will be under threat. I have to say, today we are starting experiencing this, I would say, declining power. because of that. I come back to AI. AI tells that Cristiano Ronaldo is SIU and not at European Union, Albuquerque, von der Leyen, Lagarde, and so on. I was in a panel 3 weeks ago in the US. I was chairing a panel on the question, can Europe scale? Question mark. And we had European and American panelists. And the first panelist, I asked the panelists to answer with yes or no, first round, and then deepening. And the first panelist said, I didn't know how to answer, so I asked AI to answer. Can Europe scale? Question mark. And so he read the answer of AI, and the answer was no. Europe is not able to scale because of saying that there are 2 perfect reports that are telling what to do, but Europe will never do it, and for political reasons and so on. And I asked him, but which kind of AI is this one? And of course, it was an American-based AI. Then someone in the audience read the hand, and he read the answer of a European-based AI. And the answer was, yes, Europe can scale. The main problem is that we, the Europeans, we use the American AI, not European one. So even for us, the answer, and I complete the story, I was in Shanghai last week. I discussed and I told the Chinese audience in Fudan University this story, and of course, a Fudan professor. I asked DeepSeek, and the answer of DeepSeek is, yes, Europe can scale. So at the end of the day, we have on these topics a discourse that is related to the fact that it is power. It is power, because the truth is different depending on the different AI, and the most powerful one is the American one, not the European one, because of the lack of investments, because we weren't able to put all the money that the Americans put for the development of their AI and for the attractiveness of our talents to work for their AI. So I think at the end of the day, it's a question of power.
AI is famously backward-looking and famously always searching for the answer that will make the questioner most happy with the answer. So to get it more forward-looking, you talked about creative solutions. There's a lot of talk now about coalitions of the willing, about enhanced cooperation, and yet there also is a provision in the treaty that says we shouldn't use enhanced cooperation to get around the single market, to move at different speeds. So is there a way for the E6 or a different group of countries to move ahead on single supervision, or do we really need to get some of the host countries, some of the outspoken opponents on board for this to go anywhere?
I will answer in a way in which you will be probably surprised. If we exclude the topic of the supervision that we mentioned, where it is clear that there's a different proposal and different approaches concerning 2 countries that are not the biggest countries of the European Union, the most complicated issues within the European Union on the topics of the single market are putting together the big countries on the same line and not having the big countries challenging each other for one topic or not being good in creating a coalition with the 4, the 5. I always remember what Jacques Delors told me, saying that, but in reality, it was not just because of me. It was because I had 4, 5 prime ministers pushing all together, sitting around me, Kohl, Mitterrand, González, Andreotti, and so on. And they were always pushing in the same direction, not with a dispute among them. This is what I don't see today, if I may say very frankly. Today, we need to have the package, the pillars of the European Union are the big countries. But the big countries, they have to move in the same direction. This is why the group of 6, I like it. I think it's a good point, and I hope they will be. I hope the same 6 will do the same on energy, for instance, and they don't, because on energy is a mess. because they have different approaches, and we are not able to have a European grid, for instance. And today, if you speak with an entrepreneur or all the business people around Europe, they tell you that the main problem is the energy cost today for them. And on energy, we are not able to give important solutions. The same on connectivity. You have different approach. So I answer your question saying that coalition of the willing, yes. But I would like, before discussing about coalition of the willing, having one point that I always repeat every moment in which I present the report in the capitals, I discuss with the leaders. Single market is with majority rules. Because we have this idea that everything in Europe is with the veto right or the unanimity. That is not true. All the single market issues, but taxes, are with the majority rule. And the main problem is that we are applying as behavior the behavior that the leaders usually apply within the European Council. And this is a very bad behavior. In the European Council, they, as you know very well, they don't take formal decisions on texts. In the European Council, they have at the end a document in which they have to, I would say, there's an equilibrium of the language to have everyone on board, because you have to end up all the meetings of the European Council having everyone on board. That is one exercise, very political, and I have to say Antonio Costa is fantastic in doing this exercise. But when you decide, you need to decide, even if you are 20 against 7, 22 against 5, 19 against 8. And we usually try always to apply the same method that we apply for the European Council in the councils of ministers. And I see there the problem. We have to make exactly the opposite exercise. So we need to have, using the majority rule, because the majority rule is there to help Europe to decide. And using the majority rule and taking decisions. My experience, my political experience in my past in politics, is that many times one country has to say no. But in reality, they are very happy if the others take the decision. They have to say no for political reasons, because they have to show to a national constituency, a national representations, corporations, whatever, that they are defending the national interest. But they know very well that it's important to take the decision and to go forward. But sometimes they prefer to say, okay, I abstained or I vote against. Okay, we decide and we go. This idea that we have always to say all 27 with the spirit of the European Council, I think it's a very bad idea. So I start with this point, go on. Coalition of the willing, yes, this group of the 6, I think is a positive one. But at the end of the day, the big need, this is what I asked to the leaders in Aldenbizen, they have to take the leadership of this entire initiative. Because at the end of the day, if this topic, as it happened for the Capital Markets Union, remains in these rooms or in the rooms of the experts on financial markets, I think I would say the destiny will be the same of the Capital Markets Union. So this topic and Savings and Investments Union will be a success if Savings and Investment Union becomes a topic that the leaders can explain to the people. When we decided, and when I decided at the end of the day, it was my own responsibility to say, I took different suggestions also from here, from other important central banks and so on, which terms we have to use. Capital Markets Union was not a success for many reasons. So Savings and Investments Union, I insist on the S, That was a big discussion for the capital market union. There was a big discussion on on these points. But it is fundamental because we discuss about savings, and savings are the people. And we discuss about investments, and investments are our common future. So we need to develop a narrative that can be able to extract all this discussion from all the expert closed rooms. Of course, we need experts trying to make it possible in the most effective way. But if we are not able to transform it to an answer to what is happening today in the world, with Europe, in relationship with the US, and so on, it will be very complicated. The European citizens, they have to see this initiative as something that will be useful for their savings, useful for their pensions, useful for them. Europe is giving you something positive, better than what you have with the present national fragmented situation. This is a fundamental point, but you have to speak to the people. And the same for investments. We need investments. Public finances are not enough for these investments. And using arguments like AI, in the US, they won on AI, not because of public money, because of private, because of financial investments. So we have to use this argument, and we have to be able to convince people that it is fundamental for the future of Europe.
It's a great idea. For the last question of our chat, I want to ask you about risk. One of the things that you've mentioned is, technical things like auto-enrollment, but certainly in the European country I know best, you auto-enroll into an insurance product which has no risk and no return. And in some countries, there isn't even that to auto-enroll in. So given that Europe is built on legacies, on continuation, how do we take not just risk, but the right risks? So we're investing in the future and not lottery tickets to move forward.
I try with an answer that is a little bit complicated, but I'm convinced that is the answer. Why we are so risk adverse in Europe? Not because of our stereotypes or normal characteristics, because we always use some collective psychological discourses on that. I think there's something more. And this something more is related to the financial crisis. We experienced a financial crisis that the others didn't experience. And for the first time in Europe, we had problems to taking money at the ATM. Not being able to take your money from a bank is something that is a nightmare for a citizen having his own life today, family, kids, and so on. And we experienced that. And it was years to exit from this sense of crisis. My point is that, are we sure that today we are completely out from an experience like the one we had? I think so. But I know that the lack of completion of the banking union, for instance, is creating in some leaders, in some decision makers, not an immediate, they won't tell you that in a conference, but in the back of their mind, the idea to say, if there's another crisis, which is the room where at midnight, Sunday, we take decisions, and who is in the room, is a question where there are some doubts still today in Europe. And I think this is the main problem, because if we are able to give the answer to this question, then the problem of risk aversion can be treated in a totally different way, because we can also raise the level of risks that we can take if we are able to know that there's a safety net that guarantees everything. That is what they have in the US. At the end of the day, they know that there are problems, but one night, Sunday night, they know how to solve the problem. And I have some doubts on the fact that here we know Sunday night how to solve this problem, knowing that what we had in 7-11 was something that we solved, but when the crisis was over, we stopped the integration of the banking union. And we are still there, 12 years later. And because I was there as Prime Minister. And I can tell you that it was so long time ago that I even forgot when I was Prime Minister. But the problem is still open in these 12 years. And I think it's not the right decision.
Thank you very much. Thank you, all of you, for your time. Thank you to former Prime Minister Letta for your ideas and your support of the single market. I would ask all of you to stay in your seats. We have a panel conversation next, but I hope this conversation has given you a lot to think about. And thank you.
Thank you. Thank you.
Ladies and gentlemen, again a very good morning from Frankfurt and welcome to the first panel of our conference today that has a very ambitious title, From Pillars to Portfolios, Rethinking Pensions for an Entrepreneurial Europe, and we will basically have an hour for a discussion. Before we go into that, may I remind you that the colleagues here in the room, but also online, please use the Slido for questions and interventions, because we would like also to have this very interactive discussion between the panelists and the audience. Before I will introduce to you the panelists, maybe a few words of introduction. Pension systems in Europe are rightly so under increasing attention. We are facing demographic challenges, but the good news is that we are possibly all getting a little older than our parents and grandparents. So we will have a higher population of pensioners, but at the same time, we have to cope also with a decreasing working population, and that puts the system somehow under stress. What my idea is for the panel today, that we discuss and explore the potential of funded supplementary pension systems and see how we can best increase their particular role in finally securing adequate pension income in the EU. But at the same time, that would be the classical win-win situation, also support the investments in the EU we need very much for our economic priorities and that are crucial for our competitiveness, but also for our security. And with that, I come to introduce the panelists today, and I'm very happy that Stéphanie Yoncotin has the time to join us from Brussels. Bonjour Stéphanie, c'est très bien que vous êtes avec nous aujourd'hui. Stéphanie Yoncotin, member of the European Parliament from the Renew Europe group, very well known, and she's also the rapporteur of the Commission's proposal on the PEP regulation, so a very important task, and very happy to have you here. I have on stage Beate Petri. Beate is the head of Global Pension and Benefits and the chairwoman of the Association for Occupational Pension provision in Germany, and those who master German, that's the Arbeitsgemeinschaft für betriebliche Altersversorgung.
Correct.
We have Patrick Hodges from IOPA. Very good to have you here. Patrick is heading the Policy and Supervisory Convergence Department at IOPA. We have Geraldine Legwater, if my pronunciation is correct. Geraldine is the CEO of PGGM, and those who may not know what PGGM is, it's one of the largest pension fund providers in the Netherlands, but also in the EU as a whole, so very interesting role you play there. And then last but not least, I have on my right side Tabea Bucher-Köhnen, Professor of Finance at the University of Mannheim, and Tabea is also head of the research area Pension and Sustainable Financial Markets. But let's go now into the discussion we will have today, and I thought we should have two rounds. One should more on a definition of the problem and the challenges we face, and in the second one we'll try to find solutions and ideas for solving that. So let's discuss first of all where do we stand today in the area of supplementary pensions in Europe, and what are the main challenges. And maybe I start with Stephanie in Brussels. And Stephanie, in our policy discussions, and I said it already this morning, the supplementary pension sector plays a somewhat dual role. On the one hand, of course, very important to support financial security of EU citizens, but on the other, also to help to deploy investments we need to finance growth and innovation in the EU. So it would be very interesting to get your views. How would you see the role of the pension sector with a, of course, primary function as supplier for supplementary retirement income, but what could they also do to help us support the development of capital markets?
Oh, thank you very much, Alexandra. Good morning. I hope everybody's hearing me, and dear all, very happy to participate this morning. Many thanks to the ECB and the European Commission for the invitation. I had hoped to join in person, but due to a last-minute emergency, I'm very glad to be able to participate online. Well, Alexandra, I think, yes, we're stuck in a false choice, I would say, a black and white debate that is holding Europe back. Do we want financial security or European innovation? Do we choose citizens' benefits or the success of European companies? And I think this is the wrong question. It's not an either or. I think the two basically reinforce each other. You know, first, financial security for citizens grows in integrated markets, you know, markets that offer strong European solutions. And what about European innovation? It flourishes when Europeans invest in Europe, when we move beyond national barriers and complete our single market, you know, echoing what Enrico Letta has just said. This is why a common framework like the 28th regime is so important. So I think the real challenge is not whether financial security and innovation can work together, it's whether they can succeed on their own. And right now, I'm afraid the answer is no. You know, the central challenge we face today is ensuring financial stability for our citizens, particularly through supplementary pensions. And why? Because how can we build financial security when the very word only pension triggers fear across many member states? And, you know, as a French, sorry, nobody's perfect, you know, believe me, I know what it means, you know. For many Europeans, supplementary pensions means the state will take away my retirement, or they want to privatize everything like in the US. So I think the very first step is clear. We must turn fear into understanding. And firstly, let's be honest, public pensions are no longer enough. Across Europe, in countries like Greece, Cyprus, Portugal, Malta, Poland, and even Germany, pensions can fall below 1,000 a month, sometimes even below 500. And it's only getting worse. By 2070, state pensions are expected to replace just 38% of retirement outcome, according to some EIOPA's surveys. And that means one thing: without complementary systems, we are asking citizens to face an uncertain future. And secondly, because there is a paradox. Many people are already investing. They just don't realize it. They put their money into savings products that feel safe, while that money is being invested. And take France, for example, many citizens already save for retirement through products like the PER. And the second step, after turning fear into understanding, is to ask who should lead this effort. And I think the answer is everyone. Member State must strengthen financial education and introduce it early as possible in schools, but also the pension sector carries responsibility to explain, to build trust, to engage people. So if we demystify pensions, we unlock something powerful. We give citizens confidence that a decent retirement is possible. We increase participation in supplementary pension schemes. And in doing so, we unlock long-term capital that can be invested in Europe's future and innovation. And I think back to what Enrico has just said is important. Let's start speaking all together about pension, demystifying things, and extracting ourselves from the bubble, discussing all together, because pension is something that is a common point to everybody.
Stephanie, thank you very much. And I think the last point you made, that we really have to have a much more engaged dialogue, because at the European level, because it is a really citizens' issue as well. I can only support you on that. Let's perhaps look a little bit more in detail into the sphere of non-state pensions, and maybe let's start with occupational pensions, that of course also playing already a role, but could certainly play a much bigger role in the EU and the member states. And as I said, I mean, they are, at least in some member states, an important component of a multi-pillar system, and they can certainly increase pension coverage and income. But they can possibly even be more, because they can also be an incentive for companies keeping people in the workforce, and also for talent acquisition. So maybe this is sometimes something we are not having so much on our screen. But Beate, you possibly know this all much better than I do, and therefore I wanted to ask you how you see the main challenges that the occupational pension sector is facing today. And even more complicated to ask, because you also don't have a crystal ball, but how do you think this sector will evolve in the next years, or how should it evolve?
Occupational pensions do play an increasing, or they do have an increasing importance in the system. As we just heard, that a statutory pension system will not be able to keep the standard of living in future. So I think that beneath the fact that they do have like a non-financial aspect, being attracted to employer, being bound to it. It increases attractiveness of the employer. It makes a difference if you choose, or if you're in the situation to make a choice which employer you join. Occupational pensions do play a role. This I see every day in my working life, working with BASF. We do have a strong benefit in occupational pension system, and the people love it. They say this is the factor that is the most important benefit for an employer. In Germany, we do have around 40% of employers engaging in the system of occupational pensions, and around 50% of employees do have an occupational pension. We all agree this is too few. The numbers have to increase, and they have to increase really on a high level. But I don't see the solution in auto-enrollment in the first place. I see the problem in Germany in the strong regulations and complexity the employers are facing, or the employers or the IOPs are facing in Germany. We do have a legacy in defined benefit systems with guarantees. The employers, they do have subsidiary liability. So all these doesn't give us wings, it keeps us on the bottom, so it doesn't increase the numbers that much. We face a change. We are moving to DC with the so-called social partner models. Social partners involved in the process, so the ideology of having a guarantee, this is a big step for unions to let it go. And they see how the return increases by having a defined contribution system. So I think the path is clear where we are heading and where we go, but it's a long way to go. I think you shouldn't have a view only on occupational pensions. You always have to see all three pillars, as they are interconnected, and changing in one system has changes in the other systems as well. It has consequences for the other systems. So what we do need in Germany, and they are thinking, they are working on it with the pension reforms we are just doing, is we need a reform of all three pillars. It has to be overarching. It has to be sustainable, so long-term perspective, not a short-term perspective. And individual interests are not the thing that should drive such a reform. What we need is a cool-down debate. It gets emotional. When it gets about pensions, it always gets emotional. I like it, but, oh, I'm sorry. I like emotions, but these are the wrong emotions. They trigger fear. What we should give the people is security and say, if you invest in the pension system, you have a better retirement.
Thank you very much. I have to say I also like it emotional, but sometimes it gets a bit too emotional.
Yeah.
In a sense that it should be a discussion that scares people. I think it should be a discussion that encourages people, that takes people with them, that gives a good information where we stand, what can be done more, and that there can be some passion indeed, but we should of course see this as a serious issue.
And the discussion should include, or it has to include, the truth, transparency, the facts. And this might be that it's not that the people don't like all the facts they hear. This is part of the reality as well.
Exactly. Patrick, let's look a bit perhaps more in the EU as a whole, because it is possibly not a surprise to you that also when it comes to supplementary pension system, there is a lot of variety in the 27 EU member states. So from your perspective in EIOPA, how do you see the main challenges faced by the sector, and maybe to compare a bit notes, looking into what Beate just said, what do you think are the biggest needs, room for improvement in the system, looking a bit more from the European perspective?
Thanks, and thanks also for the invitation to be able to speak to you all here today, also online. Very happy to be here. Important topic. I think actually the slide that you showed earlier, I think says it all. You see there that there is 2-3 countries with a significant sector, and the rest is really almost non-existent in a way. So I don't think I have to spend a lot of words here to tell all of you that we do have quite a significant challenge ahead of us in Europe. And why is it an important challenge to address? We strongly believe that a well-designed 3-pillar system offers the best outcomes for our citizens. And at the end of the day, that's the central point of our attention, our citizens. How can we make the best outcomes for them so that at the end of their working life, they can retire with dignity? I think this is an important key word that we strive for. And here I do think also there is a European role and there is also a European narrative to tell. Because I think in these last few years, we as citizens of the EU have become much more aware how lucky we are actually that we are European citizens, that our rights are protected. When we go online, with all kinds of elements, the food that we are seeing in our supermarkets, we are much more aware today, maybe than a few years ago we were, how a hostile world is out there and how our rules, our rule-based system in the EU is protecting us as individual citizens. And of course, this also comes to the point of having this retirement with dignity. So what are the responsibilities there? Of course, it's a member state's responsibility, but I'm very happy that the Commission indeed takes the role to push this agenda forward, because there is clearly a European dimension to it. It's about, you could say, the social contract that we have between our citizens and our government. The fact that you can expect to be protected, to be secure, and financial security is part of that security. So I'm very happy with that, that these elements are there. So a good three-pillar system. Why is it important? For a number of reasons. Of course, also risk diversification. You cannot put all your eggs in one basket. It's good that we have a pillar one system, that the state provides a minimum basis. That's clearly the foundation on any pension system there is, but we also are aware that there's challenges ahead of us, and we as policymakers have the duty to prepare our, you could say, our societies for the challenges ahead. We cannot sit on our hands and wait for the events to happen. So the pillar 2 and the pillar 3, which in our case already are important now, will become more important in the future. And what we see with the pillar 2 and pillar 3 system in those countries where you have those developed systems, you see better outcomes for citizens. Better outcomes in many ways. You see that the activities, the financial activities of citizens in the so-called silver economy, 55 plus, which I'm also in the silver economy, they are not afraid to still engage with risk-taking at an older age, because they are quite certain that they have you could say, a good fallback now. There is financial certainty that you could say influence also financial decision making up to a late age. Why is that important? It's important because, of course, for your own individual needs, but also as a society, as an aging society, that it remains economically vital. It brings the GDP. Up. Another element that is very important is the financial literacy. I think it was already mentioned by Stephanie. Start early, yes, that's one element, but it cannot only be learned at school. It needs to be a topic that is discussed at the coffee machine, you could say. And how do you get that? By bringing information, by having people engaged in their financial investment. And that happens when you are not only depending on the state to provide for your old age, but that you know, I also have a pillar 2, where there are investments, how are my investments doing? You get every year an overview, and perhaps you also have a pillar 3, where you see other, where you can make your personal choices. Maybe two other quick things I just wanted to say, because one on the example of Beate, on the competitive advantage, I see it, but I also see a downside risk there, in the sense of that it is coming with a cost. And in an increasing competitive world, where you could say the business profits are under pressure, this may be one of the things that can, you could say, die from a company. So I'm much more preferring that you take decisions as a whole, so that as a company you know that you have to go with it, because that's simply the way we organize things around here. And that comes then again back to the strength of the EU as a whole, that you are protecting also your workforce by providing them this safety. And the other thing I wanted to mention is the words we use. Because we're saying that citizens are, you could say, afraid when the word pensions falls, but let's also look at what we are saying when it comes about pensions. How much risk do you want to take? Well, the biggest risk we have is that we are poor when we get old. And exactly this is what we try to address with building good pension systems. So we ourselves are also sometimes amplifying the problem by simply the word choice that we are using.
Patrick, thank you very much. I think this is already
Sorry.
not a conclusion, but I think it describes very well where we stand today. Geraldine, I thought it would also enrich our discussion if we get a bit more insight about the work that is done by a large pension fund. And we thought you were the right person to tell us. And maybe coming back to Ricoletta's intervention this morning about the importance of scale. And rightly so, scale is an important driver for growth. But at least from our perspective, there are, of course, quite some pension funds operating, but many of them lack scale. But maybe this is not the case for the Dutch pension funds. And therefore, I thought it would be interesting to hear, managing a large pension fund, your experience with the Dutch system. Would you indeed consider that scale matters here? Is that important? And what may be the challenges for those that are not so big to achieve this kind of scale, to consolidate, to think about asset pooling? What is your experience? And perhaps also interesting, maybe not just from a national perspective, if you can say that, also look a bit outside national boundaries.
Yeah, well, of course, if you look at in general terms, scale does matter and provides in general advantages. Of course, cost efficiency, resilient organizations, and specifically for pension fund money, of course, greater pools provide you the opportunity to diversify within your investment portfolio. So that are certainly benefits that we see. But if you talk about consolidation of pension funds or even asset managers, we do believe maybe that's not the right question to ask when we talk about the Saving and Investment Union, because maybe the more important question to address is how do we channel savings into predictive investments, and there then looking at pensions and especially occupational pensions, then we're talking about, of course, that it's long-term capital. The way we organize it also with influence of the social partners that can provide trust to the system. We believe that that's the way we could basically improve the pool of assets. So it's not per se keeping the system fragmented. We believe it's important to grow the system and the amount of money in the system. And that's what why we welcome, first of all, that it's no longer just a capital market union, but of course savings and investments, because the two elements are there together. So that's, we think, a good step. And also, if you look at one of the slides in your presentation earlier on, for example, aspects like automatic enrollment, that can be very helpful to basically channel savings, not only increase the savings, but making them more productive into long-term investments, because we believe that is ultimately what we should bring into the system.
Very, very good. We have spoken already quite a lot about the supply side, to be a bit more technical, but I think it is, of course, also very important to discuss somehow what can we do to mobilize our citizens to go along this path. And I think you were already all hinting to that, because indeed, I think this is a fact that participation in supplementary pensions is low, maybe possibly too low. There was already somehow this discussion this morning hinting to, is auto-enrollment the solution for our problems? So What can we do also to inside some member states to reflect about this? Some doing it, some are things still a bit hesitant, but hopefully with the Commission recommendation on auto-enrollment, things may also change. But again, coming back to the future pensioners, I think, Sabea, we are looking into you because you have done quite a lot of work on that. What do you think is the main factors or reasons why citizens and people are not really seeing the need to take their life in their hands, or however do you say that, and think about private possibilities for enhancing their pension? We speak now a lot about financial literacy on all aspects concerning finance, but that is certainly a very, very important one. So, do you have some good news or bad news for us?
I think maybe let's start with the evidence, because I mean I'm the professor on the panel, so I have I have to refer to the evidence first. So I think if you look at this whole literature on financial literacy and how it emerged, then the big increase in and the big motivation for looking into this from an academic point of view more than 20 years ago was the changes in the pension systems that happened in the 1980s and the 1990s. So if you look at these old papers, most of them start with a storyline saying that we're shifting from defined benefit to defined contribution. We have shifts away from pay-as-you-go pension system to funded pension system, and that increases the need of the citizens to be informed about what's going on and take action and make own choices. So the research on financial literacy has a very big part of justification in these changes in the pension landscape. And so much of the early literature tried to document first what people know, and knowledge is very limited, and I'm afraid to say that it's still very limited today. And the second point was that researchers tried to establish the links between financial literacy and financial decision making. And the first papers that we had in this field were links between financial literacy and pension planning and building wealth. And there's a very, very strong link between what people know and how they are able to build wealth. And the second thing was that people also don't take the first step. So if you're not financially literate, you don't even start pension planning, the pension planning process. And so basically you have to find the starting point. And I think building financial literacy or financial capacities in individuals is critical for getting the process started. And so, so I think figuring out how to support citizens in building financial knowledge, but also in building pension knowledge is very important. And at the moment, I think the whole debate is that pensions are a complex thing, but it's not impossible to understand. And I think that needs to be one of the messages. So you can understand that. And the second thing is that I think we need to work on the myths. And so I think one of the things that I find interesting is that in pensions, you talk about long-term savings. And so I think the two, like, maybe wonders that people need to understand here is that there is the power of compound interest, and it's super important for building wealth. But many people don't understand that. And the second superpower, and that's where it comes from, just saving to investment, is diversification. So we have a lot of research also from colleagues here in Frankfurt showing that people have the perception that investing in the capital market is a super complex thing, and that you need to understand all the details. So you need to track every possible investment to make the choice of where to put your money. and to have a communication that goes towards broadly diversified and simple products where you can't make a big mistake is going to be critical for lowering the barrier for people to enter these markets. And so I think it's a matter of understanding, but also a matter of communicating the complexity of this choice and basically make it more accessible, make it more simple.
Yeah, thank you, and I think you managed to summarize a complex discussion very clearly, but maybe just picking on your last point, I think it is important that we somehow lower a bit the threshold, the entry threshold, in a way that this is not rocket science, that people don't have to be afraid that they have to become a active fund manager for a decent pension, and that they also somehow grow with that and follow it in a way, and that is also, this is a long-term process, so a little bit of a journey, but this message has to be come and has certainly also to be reinforced wherever it is necessary. We still have some time, but let's slowly but steadily maybe move in the forward-looking part to have your ideas, your reflections, how to move on in a somewhat concrete way. You know that the European Commission has also put forward what we call a package of pension ideas to foster our pension system. This is, without being too legalistic, a package of various natures. Some are recommendations to member states, especially in those areas where member states have competence, but they are done in a way that we give some incentives, some ideas, building also on successful schemes, what could be done, especially, and coming back to your last point about somehow pension tracking. I think this is also very important, and IOPA did also very good work on that, and maybe Patrick can come back to that, in a way that you can somehow follow where you stand, and I think that's also a very important incentive, that you not only realize when you are at the second half of your 50s, I should start to invest in my pension. And also maybe giving you a positive feeling that something is piling up. So this is one of them. Auto-enrollment is certainly also very important, although a bit more politically sensitive. And then there is also some, but we come to that now, reflections needed on this pan-European pension product, which really needs a new start and a good future. But maybe let me start this time by Geraldine. Especially again, looking into the specific challenges of occupational pension systems in the Netherlands. And there has been this transitioning we were already speaking about, from defined benefit to defined contributions arrangements. I guess it has also not been an easy journey to get there, and I guess it would be interesting for all of us to get your views about what could others maybe learn from the experience the Netherlands has gone through, and also how do you see this possibly playing a role in this overall discussion that we want more savings channeled to investments? What is your experience with the Dutch system?
Yeah, well, the time is certainly too short to elaborate on the journey, because we've been working on the transition for 15 years in the Netherlands, and it's a major transition. We're still in the middle of that transition from defined benefit towards a Dutch DC system. And what was already seen on some of the slides, we have a huge, of course, pile of pension money in there. At PTGM, we have done the transition, so that's probably good to mention. So for 5 million citizens in the Netherlands, we have transitioned towards the new system. And I think in the light of the discussion here, and especially the Saving and Investment Union, an interesting question might be, okay, will that change the way we invest going forward and basically the way we run our pension system. Then maybe to start with, what is the biggest change in the system itself that is ultimately for the participants or in the scheme, and that is that it's a risk transfer more towards the participants in the scheme. And there were, of course, it was first DB with a big role for the employer, it's more towards the employee. So that is a big change. But what stays in place is what I was elaborating on before already. We're there already for a long time for the long-term investments. So we do already manage to move away from just savings into hopefully productive investments. That's there to stay. What's also there to stay is diversified investment portfolios. It was mentioned already. Of course, we have the collective funds to do that. So it's still collective money that we pool together. It's collectively invested in diversified investment portfolios. So we do have the opportunity to not only invest in bonds and equities or listed equities, but even more, I think, important in the light of the topic of today, also private investments, infrastructure, etc., etc. So that was there and is there to stay. And last but not least, an important one that I would like to bring to the table here as well, it's of course risk management stays there as well, but also strong governance with influence of the social partners, which we believe does provide trust in the system as well. So even though it's moving towards a DC system, there are still collective elements there, and therefore for participants and citizens to fight trust. We were just talking about, well, it feels sometimes uncomfortable that they can rely on professionals in the system, but also the social partners in there. So that's there to stay.
Very good. Thank you very much, Beate. Also from your perspective of the occupational pension sector, what is the best investment? And there was a question this morning when it came to in life insurance, and maybe picking up a bit on that, there is of course certainly less activity by pension funds in the EU to invest in private assets than it is happening somewhere in other advanced economies. Maybe picking up from your experience, are EU occupational pension funds well equipped to invest in private assets? And what maybe prevents them to invest more in those assets?
I do think we do have the basics in many countries, but we could have more freedom in it. But what we don't have to, so we have a collective investment as well in the whole sector. So this gives trust and stability. What we do see is the point that due to regulations and risk mitigation we need to take in order to fulfill national laws like our Pensionskassen have to be fully, or had to be fully funded at all times, which doesn't make sense when you know exactly when the people retire. So, and you don't have a risk of somebody getting out of the system. But we had to be fully funded at all times. This makes investment really hard. And this now changed. We are now allowed to be underfunded in defined constellations. So this gives more freedom to invest. It's not the investment regulations in Germany they hinder. I know from other countries, I think Austria was not allowed to even put 1 cent into venture capital. But we are allowed, but we have to do risk mitigation as our task. It is to pay out the pensions safe when they are needed. So this is the goal to achieve. With the legacy we take with us, the guarantees we have, and we cannot jinx them away. They are there. We can change the system for the future for new people, and we are doing that. But you always have to think about that there's already an existing system, and what proposals do with the existing systems, coming back to the pension package and the IOP2 directive, putting new regulations, putting new bureaucracy, putting a stricter stress tests on DB systems that bear the danger to break their necks of the pension funds and the companies behind. So this is a critical factor I do see, which is not bringing occupational pensions any further. So we are talking about reducing bureaucracy. Why don't we do it there too?
Thank you very much, Beate. I was already hinting to some ideas we have from the European Commission, and we have put in this recommendation about this pension tracker, about auto-enrollment. But as Tabea was saying, and I fully agree with that, I mean, sometimes we have to also do this in a evidence and fact-based way and looking what is the situation. So again, we are profiting from your experience and also academic research. And maybe a very frank question, you think these kind of tools we have in mind will actually help people to get more in this different kind of thinking we all agree on? Or is there something else we don't really have so much on our radar screen? Do we have to look in other models? What does your research tell you, and what should we take maybe into account?
So in general, I think also looking into the academic literature, this idea of auto-enrollment has been pushed a lot also with evidence or based on evidence. But the recent evidence has become more nuanced. And maybe let me just give you a very small wrap up. So in the early papers on auto-enrollment, they basically went through the ceiling because they had these results that all of a sudden you could increase participation in mostly occupational pension schemes in the US, because this was what the papers looked at, to 80 or 90%. So basically you had it was a game changer in the sense of getting people to participate in the schemes. Now, the more recent literature has then looked not just at the immediate effect, but also at the effects of, first of all, who are the people who stay enrolled and who are the people that opt out, and also what are the long-term effects. So do people stick with these saving rates? Do people adjust saving rates if their incomes change? Do people change their investment strategies? And then again, you show that this first enthusiasm about getting everyone to participate becomes a little bit moderated by the fact that you need to keep going. So just getting people enrolled is maybe not sufficient to put them in a position to build their wealth. You also have to monitor how they deal with this pension account that they then have, and basically make sure that they stick with the savings, with the contributions, that they adjust the portfolios and so on. So that's maybe the first takeaway. So just getting people enrolled is maybe not sufficient. The second thing, and that's a little bit more tricky and also maybe not something that some of the people in the room would like to hear, is that these auto-enrollment schemes also have side effects. And especially side effects maybe on people that from a social policy perspective you would like to protect. So if you do an auto-enrollment scheme, then you are only enrolling everybody, including individuals that are maybe budget constrained or indebted. And then from a household finance perspective, you would tell them maybe it's better to first pay back your high-cost debt before you start saving for retirement. And so these kind of individual perspectives on what are the consequences, they are sometimes lost when you do these universal schemes. And then very often these are also the people with a lower financial literacy that might not even realize that they are now enrolled in something that is not the most beneficial thing. And so then we are back to the square where we need to think about financial literacy. And even in an auto-enrollment scheme, people might need the necessary knowledge and understanding of the system that they are contributing to. And so so the takeaway shouldn't be don't do auto-enrollment, but the takeaway should be do auto-enrollment carefully and look at groups that are maybe the ones that need more help than just enrolling them in a system. And then maybe the second, I mean, you can also switch, but I think the second thing is these tracking systems. And there again, we did research on the effects of providing people with these overview, or mostly like digital or app-based overviews of their pensions. And I think they have a big potential. However, and that's a general notion on all these app-based systems for helping people make financial choices, I think the biggest hurdle that we're facing is not a lack of available tools. The basic challenge we're facing is how to get the people who would profit the most to use these tools. Because at the moment, what we are seeing, at least in this pension tracking that we've looked at, is that it's mostly individuals that have high education, high financial literacy, already 4 to 5 different pension products, et cetera, et cetera. So like 80% males, and that are using the tools and basically improving how they're managing the system. But maybe we would need to think about how to get people that with lower incomes, that maybe don't have so many pension products yet, with lower financial literacy, to also use tools that might potentially help them plan for their retirement. And to think about this engagement, there we still need to understand a lot. And that's mostly in terms of policies, the question how to reach these people, but then also in terms of academic research, how to reach these people. So we need to understand much better what gets people engaged into tools that might potentially help them. Mm-hmm. And so again here, I think these tracking systems have a great potential, but just putting the tracking system out there is maybe not sufficient.
Okay, no. Tabea, thank you. I think that was very clear, and maybe we can also deepen that a bit in the discussion with the audience later on. But in a nutshell, I would also take from you, Senke, it may be fine to set it up, but it cannot just be set up and then left alone and then let people fiddle with it. But it would also need a sort of monitoring, and it can also not be a one-size-fits-all, because the audience or the potential pensioners is also very, very different, and therefore we have to think in that direction. And that brings me directly back to Patrick, because we should also not forget in this discussion that, of course, it's good to increase participation and contribution rates, but in the end, what counts for pensioners is, of course, also having a decent and good return. And of course, that all the products need to be cost effective, which is also a point we should not completely put aside. On the contrary. And there is, of course, also the question, how do we supervise all this? And is the focus on performance and costs, what we have today, is that sufficient? Or is there indeed a stronger rule needed, also looking into the cross-border concept? And I think there, as a part of IOPA, I hope you can give us some ideas. How would you see that from the IOPA perspective? Also, maybe looking into more convergence, and how is the approach you see that from the national authorities, so that there is in the end a good outcome. And we have made some proposals also recently. Yeah, also be interested too, and be frank. Yeah. How you see that?
No, thanks. Indeed, if we break it down, what citizens need for a good pension product is it's low cost, because every percentage point of additional costs is 20-30% less pension income with retirement. So costs really do matter a lot. The second element is, of course, high returns. And then the third element is the safety of the system. And that's, of course, where the supervisory review comes in. Trust was already mentioned. I think it's a key element there. So, of course, with these three components, you can build very different systems around Europe, and it's fine. But I think the aim should be to lead every outcome into that direction, so that the system, in a way, I wouldn't say forces, but is designed in such a way that the participants automatically go into low cost, high return, and a safe system. So depending on how you design it, you have you have the need for a less or more active supervisor. And if I compare it, for instance, if you look at costs, and I think this is also an important element in the proposals from the Commission on transparency. Of course, we have transparency to the individual citizens through these tools, but there is also transparency market-wide. It depends, of course, if you have a commercially based system, or you could say a more national non-profit based system. But in the end of the day, if you have, you could say, transparent information about the cost of the funds, about the performance of the funds, it in both cases will have a positive effect. In a commercial environment, you will see a development that there is you could say, an individual or an invisible benchmark, because people will look at those that have the lowest cost, will look at those that have the highest returns. What do they do well, what we don't do well? Or maybe our size is not big enough to be able to reach those targets. We need to look at partners to work together with, maybe consolidate, but not on the basis of a policy target, but on the basis of the target to get the right returns. And in an environment like in the Netherlands, where it's more, you could say, based on individual agreements, you can also still have that dimension when you see, okay, we thought we were doing well, but look at the numbers that the other funds are able to produce. Let's look back into our internal organization. What can we, you could say, increase in terms of efficiency? So we really strongly believe that transparency is a key element. But then, of course, you mentioned pensions is not that complex. Well, the problem is always how you bring the messages really simple. And there you need to make choices. You need to make choices about what you are saying, because you can't give all the ifs and buts there, because then it becomes too much. So you need to keep very simple messages, both in how the performance of your funds are, but also in the choice architecture. And I think that's another element I really want to stress here. We talk a lot about financial literacy. There is simply a group that we will never be able to reach. And do we think that is not our responsibility, or do we feel that it is our responsibility? And if it's our responsibility, let's design the system in such a way that at least someone who's never active, never looks for one moment at an app, has a low income, maybe has also some gaps to have care duties, still is able to retire with dignity. If that's the policy target, then of course in your design you need to make choices, and you need to explain those choices, that yes, you have an individual account like in the Netherlands, but there are some elements that we share together. We have the risk of longevity, we have the risk, so it's never fully your own money. That's what makes a pension product different than a savings product. You can also save money for your retirement, and then it's all yours, and you can do with it what you want. You can buy that car that you always wanted to buy, or you can buy an annuity. But in a pension product, it's different. There is an element of, you could say, care that is built into the system. I think that's the important thing.
Patrick, thank you very much, and I think you gave me a beautiful bridge to come back to Stephanie Joncotin in Brussels, to get a bit her take about the pan-European pension product. And you know, this is not a new idea. We have done it some years ago, but unfortunately the take-up was rather small. And I think what we from the Commission side want to achieve with this new proposal is a lot what you were just saying. It should be attractive. It should be accessible. It should not be too costly, so it needs to be cost-effective in order to make it really a good additional product for future pensioners. So my question, Stephanie, to you would be, as you are also the rapporteur, so you will play an important role in designing the PEP 2.0, or however we would like to call it. What does it need to have in the end to make it more attractive than it was perhaps before? And there is one important point I'm really also keen to get your views, because this is about the tax treatment of all this, because it is designed for a pan-European context, and there of course this question about tax benefits comes very clearly in. So what is your position? Is the Commission's proposal a good way to start, and how we make it in the end a successful product?
Yeah, thank you, Alexandra. I think for the PEP to support citizens' pension and also help member states close the pensions gap, it must deliver on what I would call the 3 A's. And you, Alexandra, already mentioned the 2 first A's, I would say, which are access, attractiveness. The 3 A's for me are access, attractiveness, and alignment. When we talking about the first A, which is access today is simply too limited. And I mean, echoing what the previous speakers have said, awareness is far too slow and too low. And according to EIOPA's latest Eurobarometer, 76% of Europeans, 76, did not hear about the PEP. So let that sink in. 3 out of 4 citizens. So how do we fix it? And I see here maybe 2 essential levers in this review. The first is a lever with creating a work PEP, you know. I strongly here support the Commission's approach, where second pillar coverage is missing. Then employers and auto-enrollment can really be game changers, and this is exactly how we move from a product on paper to real participation. On this access priority, the second lever could be by rebranding the PEP so that, you know, citizens understand what it is, and that is where I think EIOPA's idea to to rename the PEP product to Euro pensions is, I think, to me a great idea, because it needs to be tangible and it needs also to be understandable to the whole consumer, to the whole consumers. The second A is attractiveness, and if there's no attractiveness, there is no uptake. It is that simple. So what would make the PEP attractive? First, I believe that an attractive tax treatment is key for PEP to succeed. Every system that works, from the Nordics to France, has one thing in common: tax incentives that drive participation. And yes, taxation is a member state competence, but if we want a European product to succeed, we need a degree of European coordination and ambition. And the second point when it comes to attractiveness is risk and returns. A higher but still reasonable risk capacity in the basic PEP could improve, of course, long-term returns and channel more investment into Europe's economy. Because investments in riskier assets means investment in EU innovation. Let's not forget that. And the third point, again, when it comes to attractiveness, is simplicity. The advice process must be simple. Information, via the key information document must be simple. If citizens do not understand it, they will not use it. So it will fail. And the third A, for me, after accessibility, attractiveness would be alignment. Alignment across European legislation is essential, because if there is one thing I can't stand, it's when Europe works in silos. PEP is closely intertwined with IOP, with the RIS, Retail Investment Strategy, where I was rapporteur as well. And that means one thing: we need to push a united European approach. So to conclude, if we get the 3 A's right, and I believe I understand, Alexandra, you also agree on this point, with access and attractiveness, then and alignment. We need this to unlock the PEP's potential, and that's really, really important. It's a crucial time, and it's a collective one also.
Stephanie, thank you very much. I think with this very clear statement, let's ask our audience. We have a few minutes left before you get a well-deserved lunch after all these complicated topics, but I'm sure there are maybe some comments, questions. We have waded through a number of very diverse but all equally important topics in this issue of how can we improve our pension systems. I'm sure somebody has a question or comment either here in the room or online. Maybe we start with you, John.
I mean, this panel was really very, very good. And I think one of the most important points about financial literacy was made about compound interest. It's something that we learn at the age of, what, 12, 13? And somehow, when we start thinking about pensions, we lose memory of it. You know, and it's so important. I mean, for one way that I like to, you know, kind of, you were saying that it's difficult for people to conceptualize compound interest, and I think probably that's because the human brain has difficulty with non-linearity.
Exactly.
Many of you, also the point that you made about the 30% lower if you get a higher fee, which is also compounding. How do we, you know, this seems like a low-hanging fruit that you just, you know, explain to 12 and 13-year-olds. This is probably the most important mathematics class that we are ever going to do together. You know, stop looking out the window. How can we do that?
I'm picking it up.
Yeah, please. Go ahead.
Yeah, figuring out how to teach finance, not just to kids, but also to people over the life cycle is also one of the big challenges that we're facing. So I think we're not necessarily lacking in motivation to develop materials and provide programs. I mean, we've seen an uptake in financial literacy strategies across countries in Europe, and I think there are a lot of people in the field that have become super active, especially in the last 10 to 15 years. I think what we're lacking is a systematic evaluation of programs and the understanding of which type of material, which type of teaching method works for whom in this context. So, I mean, there's a lot of knowledge about didactics for long-established fields in education, but there is not a lot of evidence on financial education, financial literacy courses, and I think we need more evidence on that. And I think the European Commission, but also the ECB, have started to become active here also to figure out what are best practices, what works, but I think also it needs to be aligned with research in this field, because in order to figure out which programs work for whom, we need well-designed random control trials. So we need A/B testing. It needs to be according to academic standards, because otherwise we can never figure out what works for whom and why. So we need to work together here sometimes, or in this context, for aligning the policy goals with what we know and build the evidence from the bottom up to then put the money where it works the best.
Very good. John, you're happy with the answer? Good. Do we have anything online? Or for the moment not? Somebody here in the room? Okay, I think we have answered all the questions. This is a very good outcome for a panel. We have a few minutes left, but I think we are also happy to go for lunch, perhaps, if you wish. Leave me, including Stephanie, one sentence that you take as your takeaways from our discussion.
Yeah, maybe another takeaway, but something important to bring to the table in the light of the topic of today, the upcoming EORP changes. I think what's very prominent there is the prudent person rule, and especially which opportunities that provide that we sometimes forget to build broader investment portfolios, also taking into account what's happening in the real economy, but also something to take into account the disincentives we see there as well. If we then again focus, for example, in terms of performance measurement and benchmarking, if we then stick with traditional measurements there, then we can be sure we will end up with market capital weighted benchmarks with most of the investments in the US. So that requires something else to focus on the long-term investments. I think that's an important element to take into account.
Very, very good. Somebody else from my panelists?
I think we need to take decisions with courage, and we need the will to really change something. But we need to take into account that supplementary pension is not a greenfield project in most member states. And we need to have a thinking about the consequences that the changes will have on the beneficiaries, on the pensioners, and on the stakeholders.
Yeah, maybe if I can also, maybe a bit in line there, because one thing that bothered me really, and it bothers me every time I'm meeting with stakeholders on pensions, is that we are focused always on the risks, always on the downsides, where it's clear that we have a challenge ahead of us that we all must work on. And we have really good expertise in the member states that can really help us with that. So I would indeed call for, yes, there may be reservations, and you point out a very clear one. I strongly believe in transparency. I strongly believe in having clarity on costs and performance helps the sector to improve, but only, and then really only if we get it right. Because if we get it wrong, I fully agree with you, we move into the wrong direction. Yeah. So how do we get ourselves into the right direction? And I would love to have a discussion, you could say, with all the expertise around, not about your proposal, say, okay, this I don't like, this I don't like. No, the aim we all agree with, how do we get there?
Very good. I think, Patrick, with that, I leave it. Stephanie, I don't know whether you would like to make one final comment, then it's for you.
Thank you, Alexandra. Short conclusion. Yeah, I think a true pension culture doesn't happen by chance. You know, as we said, I mean, it's built through education, trust, participation. And the good news is we already have successful models. Look at the Nordics and the Netherlands. So let's start together, early, collectively, and giving citizens the tools to make informed choices for the future. Because finally, when people understand, they participate. And when they participate, Europe grows stronger. Thank you.
Thank you to my wonderful panelists on this very important but sometimes rather complex topic. But I think we got a good message across that this is a positive topic for citizens, that we need to encourage them. We have to monitor processes. It's not just to start with new ideas, but to bring them also to a good end. So with that, merci à Bruxelles. Thank you very much to all. And for the rest, time to go for lunch. And we are looking back for the second half. Thank you very much.
We have now lunch until 2 o'clock.
Good afternoon. Good afternoon to all, while some are still trying to find their seats. It's a great pleasure to have you all here back to this afternoon session of the 2026 edition of the European Commission ECB Conference on European Financial Integration. I will, in a minute, of course, present my very distinguished panelists here, but I don't want to open this session without reminding all of you of something I've just learned, and that is that Ignacio Anzalone was the one who thought of this conference, I should say maybe some decades ago already, but you can expand on that if you want to later.
I don't want to confess that, but...
Don't confess.
Yeah.
So this annual gathering has become a trusted space for open, constructive dialogue among policymakers, supervisors, industry leaders, academics, and civil society. And I'm delighted to see that that spirit of collaboration is alive and well today. Now, our panel addresses a question that is central to Europeans' long-term prosperity. How can a more integrated banking sector enhance the competitiveness of the EU economy? And this is not just a technical question. It is a strategic one, touching on Europe's ability to finance innovation, to support the green and digital transitions, and compete globally in an increasingly fragmented world. In the Eurosystem response to the EU Commission's targeted consultation on the competitiveness of the EU banking sector, it's a mouthful, published last month, we emphasized 3 messages that are highly relevant, I think, for today's discussion. First, Europe's financial and regulatory fragmentation continues to constrain the competitiveness of our banks. As the report notes, the continued fragmentation of EU banking markets acts as a brake on European banks scaling up, realizing economies of scale and competing both within and outside the EU. Completing the banking union and removing barriers to free flow of capital and liquidity remain essential steps. Second, the resilience of the euro area banks is a prerequisite for sustainable growth and competitiveness. The report highlights that banks today are significantly better capitalized, hold higher levels of liquidity, and adhere to more robust internal governance and risk management frameworks compared to a decade ago. And this resilience is no luxury. It is the foundation for supporting investment and absorbing shocks. Third, undue complexity in the regulatory framework must be addressed. As the document states, undue complexity in regulatory frameworks should be tackled while maintaining a level playing field to ensure fair competition while supporting innovation and containing risks. Simplification without lowering prudential standards can help banks operate more efficiently and compete more effectively. And these themes will guide our conversation today, which is structured in 3 rounds, each designed to build on the previous one and move us from diagnosis to strategy to action. So in the first round, we will take stock. We will take stock of where we stand. How competitive is the EU banking sector today, both within the single market and globally? And what are the main obstacles that continue to hold us back? This is our opportunity to set the scene and identify the strategic challenges ahead. And then after the first round comes the second round. And in the second round, we will explore the broader economic implications. Would a more integrated and more competitive EU banking sector strengthen the competitiveness of the EU economy? And here we will bring together political, industry, investor, and institutional perspectives, looking at financial conditions, cost of capital, market depth, risk sharing, and Europe's long-term investment needs.
And in the third and final round, we will turn to concrete proposals. What should be done? What should be done realistically and pragmatically to achieve a more integrated and more competitive EU banking sector? What are the priorities, the trade-offs, and the actionable steps that the European Commission could, maybe should consider as it shapes the future of the single market in banking? Or I should maybe say one market, I've learned today. To help us navigate these questions, we are fortunate to have an exceptional panel. Jonas Fernandez Alvarez, member of the European Parliament and a long-standing voice on economic and monetary affairs. Maria Abascal, Director General of the Spanish Banking Association and the chair of the EBF Executive Committee, bringing the industry's operational and strategic perspective. Britta Schmid, a senior EU banks analyst at Autonomous Research, offering the investor and market viewpoint. And last but not least, Ignacio Angeloni, a senior policy fellow at SAFE and a leading thinker, and very well known in this house, of course, on the structural and institutional dimensions of European financial integration. So thank you all for having made the time to come here, and all of you, and also those online. And by the way, I am instructed to also say that there are possibilities in Slido to come up with questions, etc. So at the end, I will try to make sure that we can have interaction with those in the audience, both here physically and online. So you can start thinking about your questions right now. So first round. I would like to invite each of you to share your assessment of the current state of EU banking sector integration and competitiveness, both within the single market and globally. And important, what you see as the main obstacles that continue to hinder deeper integration. And maybe, Jonas, I can start with you.
Okay, now first, thank you so much for the invitation. Good afternoon, everyone. It's a pleasure to be here to talk on this matter. And I have to say that, no, after what you said, Frank, I have nothing to add. Yeah, to be completely honest. Yeah, Commissioner, by the way. No, I think that the current situation of the European banking sector is good if we compare it with another moment in the past. During the COVID crisis, we had the possibility to check the prudential framework we put in place after the financial crisis. It's true that during that crisis, public authorities put also many measures to protect people and households and business, and protect banks too at the end of the process. But in any case, I think that we tested the prudential framework, and we have to say that the European banking sector works well, and currently, the profits capital ratio, there is not any kind of long constraints taking into account the ECB service on this mandate, on this issue. So honestly, I have to say that the situation is fine, even though, as you also said, we face a lot of challenges. Yeah, we need to increase so much the investment in the European economy, part of the through equity, another from debt, of course, and we need to review what we can do to improve the potential growth of the European economy and what we should do concretely on banking sector. And I have to say that to fulfill this objective, the best way to increase competitiveness without water down the current prudential framework is advancing faster in the banking union, in the single market, in the saving and investment union. And this is what we should tackle. Yeah, if we read the Letta's report and Draghi report, we realize that the European Union has currently a high liability, and the liability is that the single market does not work correctly. Yeah, the ECB report analyzing the shadow tariffs, the IMF report from the previous year. So we have many elements to evaluate that we have a really problem if we want to increase competitiveness, because we don't have yet a single market. The point is that if we want to advance on this matter, if we have at the end of the year another legislative proposal as we have currently on the market infrastructure and supervisory package that the Commissioner put perfectly on the table, we need to combine different views, the position of many stakeholders, and trying to have a package to be negotiated during the next year, to promote competitiveness and growth in the European economy. Thank you.
Thank you so much. Maria, I'll go to you.
Well, good afternoon, ladies and gentlemen, and thank you very much to the European Central Bank and especially to the Vice Chair of the Supervisory Board, Frank, for the invitation. It's a pleasure to be here in this important conference and to discuss about integration and competitiveness. So just looking to the diagnosis, I mean, I couldn't agree more on what you say, Jonas, that the European banking sector is in good shape, but this should not really give the idea that we didn't need any change. So my first comment would be on the diagnosis on integration. The cross-border banking lending in the EU has been limited so far. Only 14% of bank lending in the EU is cross-border. So this means that 86% of bank lending is relying on domestic banking sector. So, well, these are big numbers, and we can easily see how cross-border activity in different member states of the EU has been very limited, especially after 10 years of the banking union and in comparison with the size of the single market. Of course, this statement has some nuances because integration exists for certain market segments. For large corporate, we see that there is roughly 35–40% of the bank lending is cross-border. But for SMEs or households, this is almost absent with cross-border lending below 5%. We should think about this as a limitation for growth and scale up of SMEs, because they basically, SMEs relies on domestic banking sector. So this credit fragmentation comes with a cost because capital and liquidity cannot freely flow to where they are most productive, or we have more difficulties in mobilizing strategic projects. Many times it's true that we have large companies, but below these large companies we have a lot of small SMEs that are the providers. So what are the barriers for banks? Really, in practice, European banks have a lot of difficulties because of legal and institutional barriers on offering the same products, processes, customer journeys to their clients in different countries, even if they act with a passport. So what are the barriers? I would say that first, the national gold plating on European legislation. We have different onboarding requirements that really requires local adaptation, despite having the GDPR, which is a regulation, but really there are different national interpretations that ask for these local adaptations. We have also different client consents. We have different consumer and investor protection, which makes very difficult the standardization. We have differences in insolvency regime with different creditor hierarchies. We have also divergence in the collateral and enforcement framework. So we can think that foreclosure may take months in a member state and years in another one, and this is especially relevant in the real estate domain. We have, this has been mentioned many times this morning, the absence of the European deposit insurance scheme. I mean, that's a problem for integration and reinforce the home bias. we have also, we don't have this free flow of capital and liquidity, so we lose efficiency there. And we have fragmentation in the tax scheme. So this is also mentioned this morning, the withholding tax, but also different treatment in the loan loss provision, in securitization, and also in the, in the national measures adopted with the banking. So this creates material, legal, operational, commercial, technological barriers for banks. So really we need to fix that, because this is a constraint for growth and for European strategic autonomy.
Thank you, Maria. It strikes me that the list is long and that you know the list by heart. So we have struggled with these issues for a long time now. So, but later in the conversation, I hope we also get to some perspectives how we can improve on that. But thanks a lot. Very helpful. Britta, please.
Yeah, firstly, thank you very much for inviting me to this panel. So I'm coming a little bit from the investor perspective on all of that. And everything that Maria said basically reflects in my daily job, where we discuss whether investors prefer Italian banks over Spanish banks or French banks. It's very much a discussion around borders, with the exception of just a handful of banks. And if we dial back as to how did we even get here, in the early 2000s, we've seen a big consolidation wave where there was also investment across borders, especially the EU accession trade was very much en vogue in the time, and has created larger banks. Then post the financial crisis, we've seen a retrenchment. And while we've seen a consolidation of domestic market shares within national borders, we haven't seen that going cross-border. And quite on the contrary, actually, partly due to some European Commission restructuring plans, some banks were incentivized to exit some of their investments abroad. And since then, we've seen a handful of cross-border deals, but not very large ones, I would say, but no major change in creating pan-European banks. And maybe to add to the statistics that Maria gave, and we've heard earlier about the lack of cross-border lending, if we look at the deposit market share of European banks as percentage of the Eurozone, the largest bank has a market share that hovers around 6 to 7%, and most of that comes from its own home country, versus, for example, US banks with 13% leading market share. So there is a lot of potential, clearly. And the situation that we're in basically also results in discussions of investors around these kind of country investments, partly as a result of different economic growth prospects that we see in some countries. Loan growth is faster in some countries versus others. It also impacts the cost of equity, for example, which is very different. So undiversified banks are indirectly more exposed to their home sovereign, you could say. And then there's also another fragmentation layer that has come up in the last couple of years, which is around bank taxation, for example. It's also an area of fragmentation. All of that impacts profitability and growth outlooks, and therefore impacts how investors think about banks, and very much along national lines. It's been a long time since we've written about potential upsides from a banking union. I think investors have lost a little bit of faith around that path. There are very few businesses that have gone down the branchification route, because there's still points of friction there, and we might discuss that a little bit. We are currently in a situation where even some of the domestic M&A deals are not being successfully completed. And then there's also another point from an investor point of view, that is complexity discounts. So we do have some pan-European groups, and these are largely the ones that were created in the early 2000s, not recently. And especially in times of stress, but even in better times, this issue of trapped liquidity and trapped capital very often leads to debates around efficiency in allocation, and therefore a so-called complexity discount. Other things that we often discuss, which make it difficult for us to assess the consolidation prospects going forward, is the predictability of regulation of what a combined entity would look like. MREL is complex even for a single bank, never mind for a pan-European bank, never mind for one that wants to then also merge with someone else. And there's also a bit of a buffer debate, which we're probably also going to talk about regarding harmonization of buffers, because it really matters where you are, where is your host country. very similar with the branchification idea. It matters where you are and what deposit insurance system you pay into. So I think there's still a lot to be done. There's a lot of potential, but currently our debates are very much along national lines with investors.
Thank you, Britta. I think it's already extremely rich, and we are only in the first round, and we haven't yet heard from Ignacio. So
no need for my intervention. Everything is
well, please, no, the floor is yours.
Frank, thanks a lot for, first of all, for your words initially, very kind, and also for inviting me. I feel thrilled and a little bit emotional about being back in my old home, seeing how many friends we've worked together in the different capacities. And the thing that came while I was preparing a little bit my remarks for today, the thing that came kind of spontaneous to compare our expectations or our hopes at the time. I'm talking about particularly when the SSM was conceived, so the period between 12 and 14, when 14 was when it became operational. So our expectation then for over a 10-year horizon, more or less, so where we are now, and the reality of today. And I think it's mixed. I think it's mixed. I think we need to give 2 thumbs up for the prudential side. I mean, we've not had a banking crisis. We've had banking crises in the world, but not in Europe, which is remarkable in the last 10 years or so, which is remarkable given the standards previously. The balance sheets are more or less clean by any standards that you can think of. Profitability has been restored. With a little bit of help from my friends, as they would say, from the interest rates, which were too low at the time, and now they are more or less on balance. Stock market values are rebounded, especially recently. So the prudential goal has been fulfilled, beyond any much better than the expectations at the time, I have to say. And it's natural that this should have come first, because after all, if you read the SSM regulation Article 1, it says that banks should be safe and sound. It doesn't say that the banking system should be integrated. That's an implication. That's a sort of a second step. Okay, so the point I want to make now is that we have achieved that goal. That's a necessary but not a sufficient condition. And now we need to move forward to the next step. And the next step, in my opinion, is to have a handful of banks, or maybe 2 handfuls, but not more than that, that have the size, the business model diversification, the geographical reach, the internal structures, the culture, the solidity to be leaders in the whole dimensions of banking, not only the retail banking, which is the bread and butter of our banks, but in particular the investment banking, which is crucial for growth, and I'll come back to that. And not only that, be leader in Europe and compete globally. And that, at the moment, we don't have. So when I heard Jonas saying a minute ago, the situation is fine, I know you didn't mean that. I know what you had in mind, but the situation is not fine. Now we are ready for the second step. And what does that imply? Let me mention a couple of data that I've jotted down a few days ago. So the largest US bank which operates in Europe, actually I don't need to tell you which the largest US bank, you all know that, operating very active in Europe, is well over 2 times the largest European bank by a number of metrics. The market share of US banks combined in investment banking in Europe is greater than the market share of EU banks in investment banking, measured by total fees in all dimensions of investment banking in Europe. So even when you're talking about investment banking in Europe, the market share of the US bank is bigger than the market share of EU bank at home, in our home. The trading revenues of US banks are now more or less 3 times as big as the trading revenues of EU banks. Another thing, which is maybe a little bit detailed, but I read it the other day in the Financial Times, that JP Morgan has just announced a program to finance European security and resilience, what we talk about is strategic autonomy that we have a lot of interesting comments about, apparently now is going to be financed by the Americans, and particularly by that bank. That's a typical thing that the European bank should do. So put all this together, our banks are strong in the retail component, but the retail component is a utility. That's how I would consider. That does not make growth all in all. Of course, it has to work and it has to be efficient and blah, 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 and all these things. But it's key, in my opinion, that our banks are made stronger in the investment banking dimension. And for that, you need, as I said a minute ago, you need size, business model, diversification, and you need geographical reach. So you need these things. Now, I have a number of comments on how this should be done, but this is, I understand this is your second round. Let me just mention one thing. When I said you need a handful or two handfuls at most. If you look at the US banking system, which we consider sort of the quintessential of an integrated banking sector, there, the real cross-nation, cross-border banks within the US territory are just a few, just not more than 10, probably less than 10. Okay, all the others are local, and they are completely irrelevant from the point of view of financial integration. So that's why my suggestion, which I've written some time ago, maybe you are aware, but which maybe we're going to discuss in the next round, is that one should focus regulation on a particular subset of banks that have the culture, the ability, the business model, the capacity, and the ambition to become cross-border. That's enough to make the system integrated. You don't need to have a regulation that makes everybody integrated, because not all banks, the vast majority of banks don't have that ambition, and they don't need to be integrated.
Well, thanks a lot, and also for building in this cliffhanger that you will come back in the second round with more of this. So this is excellent. So I think that kind of like concludes setting the stage. And just to remind all of you here of the of the order of things, we are now going to try to explore the broader economic implications. Would a more integrated and more competitive EU banking sector actually then strengthen the competitiveness of the EU economy? And I think actually the most equitable, fair way of giving all of you the floor in the same order. So I will just do that. So Jonas, here you go.
No, I think that I say that the situation is fine in comparison. Yeah, what we were some years ago. But I don't know if I have to say that on this question or in the next one. But I would like to talk about EDIS, because most of the problems that we have to tackle, the national barriers that remains in the single market, I think that all of them are in one way or another linked to the debate on EDIS. At the beginning of the banking union, I think that we had two controversial points on the table. Yeah, one of them was the prudential treatment of sovereign debt. The second one was the adaptation or the situation of the Sparkasse. Yeah, so I think that we need to recognize that this problem has been on the table from the beginning. But after many, many years without any real advance on the banking union, I think that now the most problematic point that we have is the distrust among member states, among supervisors, because now with the current framework, we have a one single rule book and one single supervisor, but if there is any problem, at the end of the day, national DGS are who are behind or who have to absorb cost. Yeah. And given that, what we see is that national supervisors don't let use the capital and liquidity waivers that we already have in the regulation, even though we need to improve them. We have a real problem in the implementation of the current waivers. We have, in some cases, extra layer of capital because national supervisors don't trust others. And even though I think that the debate around EDIS is very difficult, and indeed we were not able to advance on this matter for a long time, I think that the EDIS is linked with with many of the problems that we had to advance in the integration of the banking union. Yeah, and I think that, no, as I said, it's not easy, but honestly, I cannot see any other way to recover trust, and trust is needed to reorganize, for example, the supervisory framework. Yeah, when we talk about complexity, I think that part of the complexity was born from the fragmented market. Yeah, so I think that, for example, on supervision, the system is a streamline, but again, we need to analyze that debate, trying to reduce the fragmentation that we already have. Yeah, and fragmentation also comes back to the debate around EDIS. Yeah, so I think that EDIS is key. Yeah, to try to face most of the problems that we already have.
Thank you, Jonas. I saw the commissioner making notes when you said that. Maria, please.
Well, I would like to focus now on what do we need. So we need, I mean, we have been efficient in ensuring financial stability, that's for sure, and we have avoided financial turbulences in Europe when other jurisdictions had it. But we need to gain efficiency in our framework, and we also need to gain scale. So scale is essential for competitiveness and growth, which are the most important challenge we have as a region, as society. Well, especially because we have this 1.2 trillion euros of investment needs annually to invest in energy security, data centers, artificial intelligence, defense, and so on, and rebuilding industries, capabilities, and so on. So with that scale, banks would be, or that would be an enabler for banks to diversify risk across countries, across sectors. It would also help to lower or narrow the prices that we have seen over the past decades in Europe because of this fragmentation. We see in corporates the differences between the highest and the lowest interest rates were kind of 3%, 4% in normal times, and even 4-5% in stress periods. And for mortgages and households, these differences ranges from 1.5% to 2.5%, or a little bit higher in stress time. These also, if we really make progress, as also Ignacio said, in this investment banking and scale, we would be able to fully mobilize the whole balance sheet of this big European banking group, so it's easier to finance big projects. And finally, is also an important, a critical element, I would say, to invest in technology. I mean, we need to do a lot of investment in cloud, in artificial intelligence, in cyber resilience, no? And for that, the prudential treatment of software is also important. I think that diversity in business model is good, is positive, because you can serve different clients, but really Europe is lacking a big European champion in the banking sector that really helps to, well, mobilize this investment. I also want to make a comment on the role that European banks play to develop the savings and investment union, because many times this is seen as competition between banks and capital markets, and we see quite the opposite. I mean, we think that banks are critical players, and that plays a critical role for really capital markets reaching the economy in many different ways. I mean, banks are the bridge between the savings and the investment. So what we need is really to facilitate the access of different financial instruments, investment funds, bonds, long-term savings, of course, always with financial literacy, that's clear. Banks play a critical role also in helping companies to be market ready, in the sense that we start with a long-term relationship with analyzing risk, monitoring, and with facilitating the access to capital markets through equity, through issuances. And so it's important, it's more a complementing role. And finally, of course, we also play an important role in originating and distributing that risk in the market. So it's important that we go hand in hand. Banks are really ready to play this part of the solution. We think we need both this simplification and gaining efficiency in the framework, a framework that foster growth and competitiveness, and also that foster integration and facilitate the scale, eliminating these barriers, because that would be a multiplier in Europe for growth and competitiveness.
Thanks a lot, Maria. I have to say, what I like a lot when you talk about banks, then you say we. And of course, normally in this house, when we talk about banks, we say they. But it is really very good to have you here also on this panel, so to bring in that perspective. Now I go to Britta, who talks about banks as they. Yeah. But maybe you can also shed some light on how you think that a more integrated, more competitive EU banking sector strengthens competitiveness in Europe, which is the broader theme of the second round, but go ahead.
Maria has already mentioned quite a few points, but maybe to put this also into perspective, because actually there was a question this morning, slightly, obviously not related to this panel, but it was going into the direction of how can we incentivize investment when companies are pursuing shareholder payouts, let's say. I would say we're currently in a situation where banks are well capitalized, they've got a lot of liquidity, loan-to-deposit ratios are actually rather low, I would say. At 2% rates, they are profitable. And that is a good opportunity to look at investments, and especially a lot of banks have got excess capital. And there's a certain hierarchy, I think, that a lot of management teams as well as investors share as well. The most value-generative investment that a bank can do is to grow organically at a return on equity that's above the cost of equity. Just simple example, if I make a 15% return and my cost of equity is 10%, every 1 billion invested is worth 1.5 billion. If I return that 1 billion to shareholders, it's worth 1 billion. So there's definitely a preference for growth, if we can find it. It's just meeting, demand and supply. And in the middle, there's also this M&A case. If a return on investment on M&A can make a lot of sense and is above the cost of equity, even that would be preferable to payouts in a lot of these cases. So there is an opportunity to have banks really think about how they want to deploy that sort of capital. I agree with Maria. I think banks could do more in a less fragmented banking world. There is a lot of capital that is currently meeting credit demands, I think. But banks could do more. Larger banks can invest more into digitalization, for example, and I think that's a necessity. And here we probably should stop thinking about just banks versus fintech players, but in the future it'll be more, we're all operating in one market. They can deal better with emerging risks, climate, for example. There's also structural risk around stable coins and CBDC and also investments. Everyone wants to grab the bank deposits, basically. It looks like everyone wants to have a slice of the banking deposit base, so we also need to deal with that. We need to find exit markets for banks to distribute the risk a lot better. And to your point, we do need more investment banking businesses. And for investors, that causes always a little bit of an allergic reaction, because investment banks are seen as more volatile, they have a higher cost of equity, less reliable profits, who knows what they're doing. Of course, there's exposure to non-bank financial institutions quite often that is involved. But if this can be managed appropriately, these can be profitable businesses and businesses that we need. And I think we do see some banks that you would have typically considered to be more universal banks investing more into their CIB businesses. So from an investor perspective, questionable whether it's greatest use of capital, but I think from from a broader kind of financial system perspective, this is really necessary. And I think we touched on it this morning as well. I mean, non-bank financial institutions will have to play a role. We really need to think about where banks would sit in a savings and investment union, on what part of the risk spectrum they sit. They have D-risks, and I think you could argue that the growth in non-bank financial institutions is also a result of the banks retrenching from riskier areas. And in the future, they will have to be part of a risk chain. But we need to think about whether we want banks, what type of risk do we want banks to take? So if we talk about financing innovation, startup capital, etc., that's perhaps more adequate for other areas of the risk spectrum. And this is, I think, where banks could really play an important role in terms of they've got the deposits, they've got the channeling of funding. We see more banks actually also investing in asset management and insurance business. They are interested in these sort of fee lines that I think are important for driving investments in Europe forward. So I think shareholders and banks would be very aligned there, but we just need to be able to meet kind of demand, supply, and also find a measured pace and give banks more opportunities to invest in some of these projects.
Thanks so much, Britta. Very good. Ignacio, this whole room has been hanging on that cliff where you led us in the first round. So again, I know all of you take a little bit of liberty to go outside the scheme of these rounds, which is perfectly fine with me. But just to remind all of you, we are trying, after having to set the scene in the first round, to now talk about how a more integrated, more competitive EU banking sector can strengthen the competitiveness of the EU economy. And in the third round, we will actually then ask all of you to see what could be the most concrete proposals that if you really held the pen, if it was up to you, how you could change things, what would it be? But before we get there, Ignacio, the floor is yours again.
No, I think the question you are asking us in this second round is why do we need integration? What type of integration do we need? And how that impacts competitiveness of the European economy. So not so much the banking competitiveness, which is a component, but of the whole economy, right? It's a complicated thing. Results from the formal research are not always conclusive. They're sometimes a little bit ambiguous. But the way I like to think about it is there are three channels or three ways. One is the risk sharing. So the more integration you have through the financial system, there are other avenues for integration, but the financial system in particular, which is very important in the US. The more you have that, the more the local economic shocks are distributed, etc. So you reduce the local shocks. You may increase the systemic shocks. So you have to be careful about that and have a right macroprudential framework. But that's the risk distribution aspect. Then there is a second thing, which is the more competition and therefore more efficiency. So the local markets are more contested and therefore there's more competition and the efficiency of the system increase as a whole, not only locally but everywhere. And the third, which to me by now I think not a mystery, is the most important one, is the size and scale. So the more integration you have, the more you have the possibility that local banks grow, not only locally, become cross-border banks, and then eventually down the road we will have European champions. I don't like this word, champions, but that's what they are, that's what they should be. So the risk sharing is important. It's more an issue of economic efficiency more than competition, but it may be relevant for competition as well. In order to have that, you have to have cross-border banking. So you have to have actually local banks go out and lend either directly or through subsidiaries or branches, etc. But you have to have cross-border banking activities. And we know that this is proceeding, but very, very slowly. Most of it is domestic. This is no mystery. Of the cross-border, that's pretty strange, I find. Of the cross-border lending, at least, the cross-border outside of the euro area is bigger than the cross-border inside the euro area. So there seems to be a little bit of allergy of European banks to lend cross-border within other euro area or banking union area countries. So, but you have to have, this is a process which is going on. The charts, if you look at the charts in your reports, increase, but very slowly. The second thing, the competition and efficiency, you don't actually need to have cross-border banking there for markets to be contested. The fact that the markets are open and there is one market or a single market is sufficient to make the local markets contested. And to some extent, I think this is happening. You have nice indicators in your reports that show the price convergence of price for banking products. It goes up and down cyclically, but there is some progress there. I have seen it happening in Italy, for example. In Italy, there is a big presence of French banks through subsidiaries, which they have either set up or acquired to merger and acquisition. I think that has had a positive impact on on Italian banking. So I think that to some extent, maybe not massively, but to some extent is working. What is really missing is the size and scale component, which, as I said, is, to me, a necessary condition to have a banking sector that has certain intermediaries that have the right scale, the right dimension, the right articulation of business model to be leaders in Europe. That we still don't have, and that's what we need to work for.
Thank you so much, Ignacio. So I have to confess, last night I was frantically calculating, thinking, okay, I have 4 panelists, I have 1.5 hours, I need to have at least 15, 20 minutes for questions at the end. So where should we be after the second round? And I thought 14:47 would be perfect, and here we are. So that's excellent. So now we go to our third round, and maybe it is the most interesting one, and it is the one that we want the commissioner to be writing a lot, because this is where we are going to think about concrete proposals. Concrete proposals, what should be done? And I kind of like condition this, now realistically and pragmatically, to achieve a more integrated and more competitive EU banking sector, so that 10 years from now, when we look back, we say, you know, it was not just that, you know, as you said so poignantly in the beginning, Ignacio, that, you know, looking back the first decade, you know, a lot was achieved, but that we can then also say, look at that second decade. So Jonas.
As I said before, I think that EDIS is key, not only for EDIS itself, but also to tackle another challenge that we have on the table, where I think that we will be in a better position to solve them with an EDIS in the banking union. My political group, by the way, published a report last week on this matter. So in that report, you can read more concrete proposals about what we should do. But maybe EDIS is critical for us. Yeah. Apart from that, as everybody said before me, we need to liberate banks to allocate capital and liquidity around the banking union. Yeah, so we already have some waivers, but national supervisors, I think that they don't like so much the use of these waivers. I think because EDIS is not there, or one of the most relevant points. We need also to review the framework for mergers and acquisitions. So currently, most of the regulations and decisions power are in member states' hands, and we saw some issues or some cases in the last few years, and it's true that we need more. Yeah, we need bigger banks, and we need to tackle that barriers. And I think that the current framework for mergers, given that most of them are in national hands, is another barrier. On macroprudential, from the macroprudential point of view, I think that we need to review again the supervisory framework. Yeah, we need to harmonize at least the macroprudential framework, and there are other issues. Yeah, gold plating, as Maria said at the beginning, the insolvency law. That this is another tricky point. So. No, I think that there are many proposals. Most of them are arrive on this panel, but I think if we should summarize, the point that we need is advancing faster in the banking union. Otherwise, we will not have investment banks or bigger banks, or we will not be able to provide loans to the challenge that the European economy has. And we will not be able to exploit the efficiencies that now are there, but we don't exploit them.
Very clear. Thank you, Jonas. Maria.
Okay, well, that's my favorite question.
I know. So actually, I can allow you a little bit more time because we are doing well. Yeah.
No, so well, I think that the main priority and the main take is to have the focus on growth and competitiveness. I think that this is a cross-cutting demand from all the industries in Europe, transport, agriculture, pharmaceutical, cosmetic, and banks too, of course. We really very much welcome the European Commission consultation on the competitiveness of the banking sector, and also the high-level report by the ECB with measures to gain efficiency and simplify. I would like to say that the banking industry is not really asking for deregulation and dismantling all the financial architecture. What we are asking really is to gain efficiency and rethink a little bit the process. If I would have to summarize or to highlight 3 changes, first would be to have a holistic view on the capital requirements that banks are having, and also to have stability on that capital. As we have said, there are broad consensus that the European banking sector is well capitalized, of course, because we have a very robust prudential framework, but it's true that we have a very complex framework. So we have European banks needs to deal with more than 20 authorities. They work on silos. So, there are layers and layers of regulation and decisions. So our first proposal is that we simplify that framework by identifying overlappings. The macroprudential framework is also by eliminating gold plating on international standards. We remember that we have 140 RTS by the ESA, so this makes the whole regulation more difficult. So our proposal is, we should allow or introduce a mechanism to coordinate among different authorities, so they speak to each other before making their decision, because this is the way to identify if they are just touching the same bottom. So they can identify overlappings with the commitment to eliminate those overlappings. And then stability on capital. We are not asking for reducing the capital, but we think that European banks have enough capital, and that we should somehow avoid the trends we have seen over the past years of increasing continuously the capital through different mechanisms, different layers, included also supervisory discretionary decision. You know that we have this report by GARP that estimates that only over the past 4 years, this capital add-ons has increased by 100 billion euros, which means, in practical terms, lower credit to the economy in 1.5 trillion euros. So, we need to make sure that those, of course, this is macroprudential buffers, national authorities, European authorities, and different actors making decisions on a single entity. So here again, we very much welcome all the proposals to gain efficiency in the supervisory processes. For instance, to be proportional on the risk you are addressing when opening a supervisory action. We know this is a little bit the plan. Enhancing coordination between GST and horizontal teams. So really they share better information without consuming a lot of resources within the bank. that would be part of the solution, having this holistic view on the capital that we are asking to the entities. The second is to broaden the regulatory and supervisory culture, in the sense that it's true that since 2008, the focus has been on financial stability, and rightly so. I mean, financial stability should be preserved, absolutely, but what we say is to broaden and widen a little bit the focus to take into consideration also growth and competitiveness, as other jurisdictions are doing. And here again, we have received the challenge by authorities saying, well, but Europe is different, because within the SSM, the SSM is simply a supervisor and not a regulator. But practitioners, well, what they experience de facto is that this is an extra layer of regulation through guidelines, expectations, interpretations. So I mean, the idea is to broaden this focus, so they also look for growth and competitiveness as other countries, not only the UK, is doing, and also reinforcing accountability, in the sense that, well, we need also to enhance ex ante and ex post impact analysis to make sure that the decision, both regulatory or supervisory decision or measures we intend to adopt, are fit for purpose and really fulfills the policy objectives we want. Because this way we think we somehow change the culture. And also, I mean, that would be a little bit on broadening the focus. Finally, we have discussed a lot today, scale and integration. I think that's also critical. For us, is the time to complete the banking union. And this has different elements. Of course, we have the SSM, we have the SRB. Now, we think it's time to complete the third pillar, the European Deposit Insurance Scheme, but it's also the time to make sure that we have free flow of capital and liquidity within the banking union as a single jurisdiction. It's also the time to have more confidence and reassurance that we have the liquidity we need in case solvent institutions need solvency in stress time. We have that framework, but at national level, it would be good to have it at European level, as the US has. And of course, also it's important politics, because we see many times that there are different initiatives that cannot succeed because of politics. So that would be a little bit the summary. And for us, we see progress in the sense that there are political support. I mean the Council, the European Council, the Commission, the ECOFIN, they are discussing about that. But we really think it is time for political movement and not just for technical discussion, because we already have presented very detailed proposals. Thank you.
Thank you so much. Very clear. Britta.
Yeah, hard to follow, given such a list already. I think the main thing is really, if we boil it down to that, I think from a market perspective, the issue is not really regulation. We've done a lot on regulation. The question is really the political willingness. And we can talk about EDIS for a long time, and the question really is how much more capital, liquidity, and resolution funding do we really need for there to be finally enough trust? Or is this more a matter of public sector deficit situations or industrial policy around the banking system that prevents this from moving forward? Because then the answer doesn't really lie, I guess, in anything that we're discussing around the prudential side. So of course, you know, a workable form of EDIS would be a dream and would be very important to create those couple of pan-European champions that we were talking about. In the absence of that, allowing large branches to operate would be a workaround, but it does require the capital waivers where we are still stuck as well. I also think that we need to think again about M&A interventions and to what extent this should be left to shareholders, or where the intervention level should really be. And recent deals have shown that this can be a very emotionally charged debate as well. So I think that really is, all of this topic of political willingness is probably a little bit more difficult to get our heads around. On the prudential side, there are areas where we see some frictions that make our life as analysts quite complicated that could potentially be addressed. So for example, the different scalings of OSII buffers, how it's treated in different countries. We've added now the banking union floor, but that's just a floor. There are still some outliers to the up there. I mentioned MREL already. I think really that perhaps it would be useful to have a review there and think about where we are, where we have the capital buffers. And I think what would also help is reducing authorization times for M&A deals. We see a big difference in Europe versus the US, for example. And then lastly, I think we haven't really talked about it all that much, but what we hear from the banks is that there are a lot of interoperability issues as well. So cross-border payments, for example, or payment systems, retail instant payments, cross-border, generating a European stablecoin, for example. I think there's probably a lot of work that we can do there as well, which might be some easy wins that could be very helpful. Yeah.
Thank you, Britta, for building on this. Ignacio, your pragmatic list.
No, I also had a clarification question or comment on Maria. Maybe you want to, the interaction you want to do later. But no, I've heard with a lot of interest and attention all the comments that have been made around the table. They are more at the margin, the more on detail aspect that can marginally be improved, as opposed to the thing that I would like to recommend, which is a little bit more radical. So, but of course, I'm mindful of the motto that says, be careful what you wish for, because it may come about. And then you are on the line. Ah, you recommended that. What a disaster. No.
Don't hold back.
2 or 3 years ago, I wrote a report, which actually was for the European Parliament, in which I recommended basically, it's a very boring, long, and complicated report, and very technical, but the substance was, okay, you want to make cross-border banking real, right? So what do you need to do? You need to eliminate all the legal impediments. It's a necessary condition. Then we have to see if the business practice of the banks actually follow up. That's another thing. But okay, supposing that the obstacles are removed, which are these obstacles? The obstacles are all the provisions which, if I remember correctly, Article 6, 7 of the CRR or thereabout, of the European regulation, which gives rise to ring fencing. So that prohibits the efficient distribution and allocation of capital resources, prudential resources, large exposures, etc., from one country to the next, which are largely, if I remember correctly, I'm not a legal expert, but they are actually in large part inherited from previous regulation, previous legal bodies, which were there and have remained more or less intact after the CRR-CRD construct has been put in place in 2011 or 12. So remove those. At that point, you are in a risky situation. Why? Because the location of the risks, the geographical location of the risks, may no longer correspond with the geographical allocation or positioning of the buffers, of the prudential buffers. So what do you need to do? You need to make sure that as ex ante there is freedom of movement of the exposures. In a crisis situation, there has to be mobility of the safeguards against these exposures. Okay, so capital liquidity have to be able to move up and down the ladder, the group ladder, from the subs to the center or from the center to the subs, depending where the problem is. So you need internal support agreements within the cross-border groups, which have to be enforceable. This is a legal complication. You have to make it enforceable. And you need, and here I come to the last question, so the deposit insurance. You need a deposit insurance which is mutualized and backstopped, specific for those cross-border banks. Okay, which I think, so the question, of course, you would need to, a certain complication, you need to spin off the cross-border banks from the existing deposit insurance structure. So there would be structural changes to be made. I think that one big political obstacle to EDIS would disappear, which is the small local banks would no longer be involved. Most of the political resistance at the moment against EDIS is precisely there. So local banks say we have our own local pool of risks. We don't want to have anything to do with the foreign banks. Maybe take the risks that we cannot control, etc., etc. So leave those out. They are not into the cross-border and integration business. So do something specific for the cross-border banks. And of course, you have to liberalize, but at the same time, on the same path, you have to review the crisis management and prudential framework. So the two things have to go together in order to be safe. I realize this is much more ambitious than the recommendations that have been made around this table or around these chairs. But I think we also have to look a little bit farther out and be more ambitious.
Thank you very much, Ignacio. There is in supervision this term which is called RWA density. Some of you might notice. I think there's also something like idea density. And I think that if you think about the briefness and the succinctness of your interventions and the richness of the ideas, we had a very high idea density. So that is much appreciated. I think we have a little bit of time to interact also here on this panel. Maybe I want to break the ice there. By replying maybe to two of the things that you said, Maria. You asked for some kind of a mechanism for a holistic approach to capital, not just having all these various actors doing their own little thing, and then suddenly you are the receiving end of what they. So as you know, but maybe not all here in the audience, in the high-level task force report. That was adopted in the end also by the Governing Council. There is a very concrete proposal for that, to use what we call the macroprudential forum, which is the Governing Council and the Supervisory Board together. And by the way, and I see Roberto here in the audience, we can, that is a forum that is sufficiently flexible to also invite other authorities, so we could bring everyone who is relevant to that table to actually do just that. So in the end, of course, the various authorities will have to play their mandate, but nothing stand against them coming together in a structural manner, ex ante, to try to see whether we can form a holistic view of what adequate capital could be. And let me also say here, from my perspective, indeed, also I think that the European banking system is well capitalized. Let's not forget that. That's the first maybe reaction to what you said. The second thing is you said something about the guides, and I think there, the very short answer is I think you have a point. I think you have a point. So over the years, we have come up with a lot of guides, supervisory expectations, good practices, and by the way, many times on the request of the banks. Not always, but many times on the request of the bank, saying, okay, it's all very well, but there is, of course, something like an equal treatment imperative for you as a public institution. If you do something to one bank, you're also supposed to do it to another bank under the same kind of circumstances. Maybe it would be good if you were to be transparent about that and accountable about it. So why don't you write that down so that we all know? But still, if you go through these guides, I think we have sometimes not been. There's always, good legalese in the very beginning. This is non-binding. Mm-hmm. So it's there formally. But if you go through it, there's language where you think, well, maybe we pushed the limit a little bit too far. Maybe we actually were not as disciplined as we should have been. So we have embarked on quite an exercise where we say, okay, we look at all these guides, mm-hmm. and we're going to clean them up. Maybe we can retire some of them. Maybe we can retire some parts of it. Maybe we can clean up the language and really live up to what we promised, and that it is non-binding. So they are good practices guides, and you can you can be a very perfectly well-behaved bank without following any of these good practices because you have found for yourself better practices. Then maybe you qualify for the next version of that guide so that you can give some even better practices to the community. You know? Now, not only that, because that's still not enough. So you really have a point. Because it's one thing that we clean up these guides. Another thing is then what happens on the ground. So do the supervisors on the ground, in the trenches, in all their hundreds, thousands of interactions with the banks day after day, do they then actually treat them as non-binding, or is it becoming then in the end? So there's also a cultural issue there. So we have embarked also on a parallel cultural change program to make sure that we live up to that. So these two things I wanted to just highlight. But Ignacio, you had another question.
I don't want to overburden Maria because my question is also, okay. No, I was curious when you said in the first group of recommendations that you made in the last round that you want to see more coordination or more dialogue between different supervisory authorities. Let me be simple. I thought there was only one supervisory authority, which is the ECB. Which authorities are not sufficiently coordinated in your view? The nationals and the center, or the SRB, or who?
Yes. Well, we are thinking of having the microprudential supervisor, so the SSM, but maybe for the it's different. The macroprudential, macroprudential, because many times the microprudential supervisor may be toughen specific risk weighted in a model or on the standard.
You meant the macro. You meant the macro.
The micro, the SSM, but at the same time you have the macroprudential authority working also, for instance, on similar. I don't want to really be very specific because I don't want to talk about Spain. I mean, but you know, it's in all the countries we see that both the microprudential supervisor and the macro one, the one in charge of the macroprudential policy, well, they can overlap among them because they touch and decide on similar things or at least things that are very much interconnected. So it really results in an overlapping.
The macro should be with the ECB. I mean, I'm free to say that now. The problem, that's the problem. The macro should be with the ECB. And this incredible solution that was not the second best, but the last best at the time of having this asymmetric, whereas the ECB can only top up. I mean, that is something that was guaranteed from the beginning not to work, and it hasn't worked.
But maybe there is another point on this matter between the banks or supervisors inside of the banking union and outside of the banking union. Yeah, for example, Nordic banks. I have many conversations with Nordic banks. Some of them have activities in the Eurozone, in Finland. Others activities outside of the Eurozone. And I don't know, but maybe
that was part of the problem at the beginning.
They need to enter in the euro. Yeah, I know the answer.
It was a problem of the UK.
Yeah,
the UK was still there, right? Yeah. So they were the most, most tough in the negotiation. No question. Okay, now I understood.
So the panel, we are very happy with ourselves here, which is good. But I would like to actually see whether there's anyone who would like to join this conversation from the audience. Oh, I see various hands. That's very good. Please go ahead. One, two, at least.
Hey, does this work? Does this? Yes, it was.
Maybe please state your name and then.
Yeah, Linda van Hoor. Thank you so much for all the wish lists. Apparently, Maria, you really like the Brazilian approach where they don't have macro anymore. They just have monitoring and supervision. They replace backward-looking reporting by real-time data sharing, enabling forward-looking supervision. But you are in the biggest bucket with Itaú and 3 others, so actually, let's talk about that further. No, we are not dealing with the real problem because we see that member states genuinely love fragmentation. I mean, we know all the advantages of integration. We know all the costs of fragmentation. We know what it would do to competitiveness. We know what we need. We have a plan. But the member states again and again and again choose for fragmentation. That cannot be because of knowledge. That must be because of a feeling of fear or something. They feel something that's blocking further integration. And I think Ignacio sort of referred to it, Letta also referred to it. What is it? So my question to you is, what would you say to member states who are afraid of losing something when they open up to an integrated market? When they allow for European champions instead of national champions, when they allow for European infrastructure instead of all those national agents. I mean, maybe it can be a loss of loyal investors into sovereign debt. Maybe it's a loss of jobs in politics. I don't know. What is it? What would you say to member states who hesitate, who are apparently afraid of something?
Linda, thank you very much. I've spent 5.5 years here to try to show that Dutch are not always direct and plain speaking, but you just... Anyway, thank you so much.
I love you, Frank, you know that.
In the back, and we take at least two, and then we can see.
Thank you. Marco Triano from Scope Ratings. It's actually a question in a similar vein. I think, we have a lot of diagnosis, 2 reports, Letta mentioned it today, but it's clear that the underlying topic is political willingness and whether we can move forward. Now, about 15 years ago, a wise man here said to the markets speculating, do not underestimate Europe's political capital. And my question is, do you think maybe today we are overestimating Europe's political capital? And we're all Europeans in here and in the institutions, we have strong agencies. But is the willingness out there, outside of the institutions, still sufficient? And can this capital be mobilized in peacetime, or do we need to wait for a crisis for things to happen?
Do we need a crisis? Very good.
But we are in a crisis. No?
Jonas, you have the floor.
No, I have nothing to add to the last question. I think that after this panel we have the possibility to listen to our commissioner, and I think that she is in a better position to explain how we should exploit our political capital during this mandate. Yeah, but the point is that maybe we are not seeing correctly that Europe is in a very difficult situation. Yeah, I said at the beginning that our banking system is better than in the past. But maybe we are seeing a crisis in a televised process, or like the fog in the hot water, yeah. And I think that this kind of pseudo crisis or whatever is more difficult to identify by the public, yeah. And I don't know. We are at the beginning of the mandate in any case, and I have at least a high expectation for what our commissioner will put on the table in the future, as she did with the market integration package. And to the first question, member states, I was sitting with the council in many trialogues during these years, and I think that there is not any other exercise in the parliament which we would like more than criticize the council. Yeah, so we always say all the problems are always in the council. Okay, I have to say that most of them are in the council for sure, but it's not easy. Yeah, during the implementation of in the trialogues of the CRR-CRD, the last Basel implementation in Europe, in the Parliament, the negotiation team introduced, for example, the application of the up-to-floor at consolidated level solo. Yeah, I think that. Not taking into account the banking union, and we try to facilitate the use of the capital and liquidity waivers, yeah, through different articles, yeah, and during the trialogues it was completely impossible, yeah. So we really like to criticize the council. I think that we have good reasons to do that, but we need. I don't know. It's not easy to answer.
Maria?
Yes, a brief comment. I mean, I think that the world has changed so much. So really, Europe needs to react to the current challenges we have. And really, the way forward is to have more Europe. And really, our best asset is the euro. This has really provided with a lot of stability to the whole region. So if we don't join efforts with that specific challenge we have, low growth in Europe, we are not going to really react and make the reforms we need, the investments we need to really maintain our certain economic power in the world we have today.
Thank you for celebrating the euro. I would add soon in digital form in a device near you.
I hope so.
Britta?
Yeah, I mean, maybe to the first question, I think it's also perhaps worth recognizing that even if we had a banking union, not everyone would necessarily make use of it. We would have perhaps a couple of larger pan-European banks, but it's not like every single deposit in every country will fund lending anywhere else. And I think, similar to Maria's point, if you want cross-border investment, it would be great to have banks that can operate cross-border to go along with that. And then with regards to the other question as to what would really be the impetus, I actually also wrote down crisis. So I think we all agree that a crisis always shifts mindsets. But there are a couple of tendencies where we do see a little bit of, let's say, industrial policy or also protectionism around what are sovereign bonds. I guess if we had an environment where it wasn't retail deposit money that was basically indirectly funding the sovereigns, but where the sovereigns could fund in more private markets and the deposits could be deployed elsewhere, I think that would probably alleviate some of these worries.
Ignacio?
I don't have much to add. I think both questions were sort of political, so it's entirely appropriate that Jonathan answer them. My instinct would be, whenever you see an insurmountable obstacle, don't keep on bumping your head against it, try to go around it. And I see, for example, the question of having an omnicomprehensive EDIS, so an EDIS that covers all banks in the whole banking union area, is probably one of those insurmountable obstacles, because there are a number of banks, I'm repeating my argument now, but there are a number of banks which are exclusively local. They have their own arrangements, they have their own risks, they don't want to be involved, and they have nothing to do with whatever we want to implement in terms of integration of the banking system. So leave them alone. That would be my... So that was part of the reason why I came up originally with this idea. Okay, select a number of banks that really matter for the goal that you want to achieve. Be pragmatic and try to design an arrangement for those banks. I think that also Politica has a better chance.
No, if I add something on this matter, I will not enter in the debate itself because I'm not in that position to debate now that proposal. But I think that proposal links with the debate around proportionality in some way. Yeah. So, and proportionality, the point is that if, at least for me, proportionality is another debate completely linked with the banking union. If we will be able to advance more in the banking union, I think that the debate around proportionality will be easier. The point is that now, even from a regulatory point of view, in our CRR, there are many requests, ring-fencing, you said before, taking into account the national reality markets. And given that we take the national markets to regulate, it's more difficult to introduce more proportionality because we don't have, from a regulatory point of view, a truly banking union. Yeah. So without entering on your proposal on EDIS, for example, in the definition of small and non-complex entities, there is a reference taking into account the reality in every member state. Yeah. There is not only a definition taking into account the size of the risk of the balances. There are also arguments in the articles to define some banks no significant because in the local market could be relevant, even though the same bank in another country with a bigger bank with a bigger market will not be significant. So with EDIS and with other ideas, I think that we need a push in the banking union to consider or to analyze properly what is the correct level of proportionality that we need.
Thank you, Jonas. There's actually still time for some more questions. Yes, please. I see two there on my left and one on the right. So that's three. I'll take all three together and then we wrap up after that.
Hello, can you hear me?
Okay. I have a question to Mr. Angeloni regarding this proposal about, let's say, different regime for cross-border and large banks, and this idea of EU champions, basically. Also, in comparison with...
Speak a bit louder if you can.
The idea of the EU champions.
Yes.
Also in comparison with the US banks. Would this idea, let's say, mean also a split between investment banks and, let's say, retail banks, so that these cross-border banks and the regulation and the mobility of capital would only apply to investment banks, also financing a large corporation while leaving, let's say, retail banking to domestic markets, also in order to ensure a sort of level playing field between these large banks and small banks within the EU?
Very clear question. Let's collect quickly the other ones.
Thank you, Ilya Lingorski, Bulgarian National Bank. Following on the previous question towards Ignacio, but also Maria, if the Americans go on a deregulatory spree over the next couple of years, and given everything Mickey Bowman is saying, as well as what we hear from the top 10 CEOs before Senate committee with regard to Basel III and capital and buffer and all other requirements, what should be the response with regard to creating these cross-border champions from, on European soil, given the fact that the level playing field may be slightly tilted if the Americans really decide to go on a very ambitious deregulatory tour?
Very important question. I saw one, Malte, please, and then we take him here.
Thanks a lot. Yeah, I can be quick because it follows directly on the first question also to Ignacio. It's essentially, if you have a pure cross-border EDIS, aren't you concerned that essentially you would take out the most diversified institutions and you sort of leave behind a set of less diversified, smaller set essentially, from insurance logic, so to speak, that you're kind of like cream skinning and, you effectively not enhance depositor protection across the euro area, which was the initial goal, but you may even weaken it if you have the sort of two-tier system.
Yeah, understood. Let me start with the last one. I don't think you would have a less diversified. You would eliminate certain components. You would have to spin off. I think those large banks would be by nature, by construction, diversified geographically at least, not only Europe and euro area, but also globally. So diversification would be there. You would have a smaller pool, no question, and you would have a problem of spinning off those big components from the existing. But I think in terms of diversification, I don't think you would have that problem. I don't think you would have that problem in terms of diversification. Would have to be studied. It would have to be studied. So one would have to make a very good calculations of what would be the subset of banks that can participate to this restricted club, so to speak. What are their exposures? What are the stakes that they already have in the existing deposit insurance schemes, and how would they be transferred? So it requires a lot of calculations that I didn't do, but could be done. The information exists and could be done. So that would have to be studied in depth. The first question was, shouldn't we, if I understood correctly, separate still, the old Glass-Steagall idea that was in the end was abandoned, to separate commercial banking from investment banking. I'm not a friend of that idea. I understand that there are risks from the intermingling of the two, but there are also complementarities, because the investment banking part requires a pool of liquidity, which the commercial banking part provides. And so one has to find and there's no coincidence why at the end of the last century that system was abandoned. And that was the beginning of sort of the big banks, the big US banks, which I think all in all successful, with problems, but successful. That comes from there. So I have not much sympathy with that I think is not very realistic, particularly in the modern world, in which it's very difficult to have regulation that segment different lines of business. The second question was the most complicated. I mean, I will be curious what Frank has to say about that. If the Americans go a certain way, should we follow? Or to what extent should we follow? Because I don't think we can completely ignore. I mean, we have to compete with these guys. So I think to some extent, we need to be flexible in that respect. That's my own personal view. But to make a good compromise. Frank, please help me on this because you know much more.
I'm looking at the clock and we have 1 more minute. But I will...
very prudent supervisor.
So Maria, why don't I give you that 1 minute to you and then I will wrap up and I will promise that in that wrap up I will say something on this.
Yes, well, I just wanted to react by saying that we are not asking less capital for European banks, but of course, competitiveness is a dynamic concept. So, well, you can see that the UK has already presented the idea of reducing the capital benchmark for their system. The US also has presented different reforms, and it results in an overall decrease of capitals for the largest banks. So, what we want is stability in capital. So we will be happy if capital stop increasing and increasing, especially without, I mean, specific mention. And of course, I think that Europe should take a look of what other countries are doing because we need to preserve this level playing field.
Thank you so much. As promised, I want to stick more or less in time. So I'm going to wrap up and I'll do that fast. I want to thank all of you for what I thought is a very lively and rich debate. I want to thank all of you for contributing and for paying close attention. A couple of things that I heard. I heard you, Ignacio, giving 2 thumbs up for the last 10 years on supervision. That is a great thing to hear. Thank you for saying that. And I really hope that 10 years from now, looking back, we can say the same. For what we have achieved back then. I heard the chair of the EBF Executive Committee not once but twice say that the banks do not need, literally, you said that, reducing capital twice. I heard you say that. But it is also true, and I have to be fair, that you said, but we want more proportionality, we want simplification. And actually, I think that on these things we can shake hands. I heard Ignacio giving us a very clear advice that we shouldn't be headbanging on the biggest problems, but we should try to slice and dice them and to maybe walk around. I heard Britta and others talk about the need for scale. We talked about cross-border banking integration. I promised I would say something on what do you do if, of course, international banking is by definition served well by a international level playing field, and if that playing field were to no longer be level. Now, first of all, some of these things that one of the distinguished the colleagues in the audience refer to is still hypothetical. We have to see how things will go. But of course, this is a very valid question. What do you do if in the end you want to achieve something with other jurisdictions, but they don't play ball if they were not to play ball? Now, for example, so I don't want to just be so very, very high over. On the FRTB, you know that we have been very clear in our support for the Commission proposal to have, I think, a very nuanced way of doing things. We could have said, as a supervisor, remember there's Basel, and we just want everything to be implemented in time and fully and without any flexibility. I think there we have been, the Governing Council has issued an opinion clearly throwing the way that we have behind the European Commission's approach, which is something less than just implementing, but seeing also what other jurisdictions do. So there is something to be said for of course being very much aware of what happens in the world. But on the other hand, it is also true that if there were to be a real race to the bottom, there comes a point that one has to think at the bottom we all drown. And we also don't want that. So finding the right balance there is very complicated and is something very difficult to comment on in a more hypothetical sense. That's why I mentioned the FRTB as an example where I think that nuanced approach has been found and where also we as a supervisor and as the European Central Bank have shown that we can understand that. Now I have good news for you and bad news. The bad news is there is no coffee break, no tea break, but the very good news is that you will get instead something much better, which is the Commissioner. Thank you so much. Thank you, Maria.
Thank you.
Association more easily between Ronaldo and SIU than it does between Albuquerque and SIU. And I checked, it does. Apparently Ronaldo does a kind of a jumping spin after he scores a goal and screams out, "See you." I'm not a fan of football, so I didn't know that before. But might I suggest that Ronaldo is a lot easier to spell than Albuquerque, and that maybe the misplaced association is more a reflection of the state of the spelling skills of American AI. And dare yeah, the King Charles speech, I think, rubbed off on me. So how does one introduce the person who needs no introduction? European AI does make the association between SIU and Maria-Louise Albuquerque no problem. So for spelling queries, we now know which AI to use. Commissioner Albuquerque will now deliver her keynote speech, and she told me earlier that her favorite part of a speaking appearance is the Q&A part, and I think you already have a question lined up, and I would recommend to colleagues in the audience that you think about your questions in advance. I've seen her in action doing Q&A. She's good, and we look forward now to the keynote speech. Thank you.
Thank you very much, John. And I'm really happy to hear about the association between SIU and Ronaldo, because I mean, talk about an audience and the outreach. I have to try and ask him to support the SIU. Okay, so good afternoon, ladies and gentlemen. It is a pleasure to be here among elected officials, esteemed colleagues from the European Central Bank, other EU and national authorities, academia, thought leaders, and partners from industry and civil society. Bringing together such a broad range of perspectives is essential to informed policymaking. This diversity is what allows us to get it right. And perhaps more than in the past, I sense that we are increasingly aligned on the direction of travel. It's unlikely that I am the first to bring it up today, even if it wasn't that too visible in the last panel, but the geopolitical context matters here. Over-reliance on others has left us exposed to shocks, especially in the current context where predictability is diminishing. We have witnessed this clearly in recent years. Energy price shocks have fed directly into household budgets, and the euro area's macroeconomic outlook has been adjusted, bringing with it renewed concerns about stagflationary dynamics. We must recognize that the current geoeconomic context is our new normal and ensure that our economy provides protection from shocks outside of our control. A stronger and more integrated single market, truly one market, including a stronger European financial sector, can build our economic defenses, including to shocks like the one we are currently experiencing. Of course, there are entrenched views in the debate on more financial integration, already referred to here as well. We all know this well, and they have held us back for years. But increasingly, the bigger picture and the importance of a well-functioning single market is becoming impossible to ignore. Since March last year, we have been working to turn the SIU from words into action. We have published plans for financial literacy and the blueprint for savings and investments accounts, recommendations and legislative proposals on supplementary pensions, all of this aimed at getting citizens involved in capital markets and giving them more opportunities and incentives to save and invest. We have put forward measures to boost the availability of equity financing, including for pension funds and insurers, to ensure that more of Europe's financial firepower can be directed towards those companies and sectors that will drive the economy forward. These long-term patient investors are absolutely critical to our success, and we are working to ensure that there is nothing holding them back. But underpinning all of these aspects is our market infrastructure, which is not working effectively and is a drag on our competitiveness. Last December, we put forward the Market Integration and Supervision Package, which is a highly ambitious package and is firmly focused on integration and simplification. It removes obstacles to cross-border provision of services when it comes to trading, post-trading, and asset management. Together, these sectors provide the essential services which enable intermediation between investors and those seeking finance throughout the Union. It also aims to make supervision more efficient by moving it to ESMA for significant market infrastructure and for crypto asset service providers. For those offering services across our Union, we need to be able to offer a streamlined supervisory approach. The MISP focuses on integration through structural changes to our financial system. But at its core, it's really about being able to allocate capital throughout the EU with ease. But while our work on capital markets is essential, we should not lose sight of the central role that banks continue to play in Europe's financing ecosystem, and the work that remains to be done to create a more integrated and competitive banking sector. So since the beginning of this mandate, all new and revised initiatives are being examined through a lens of competitiveness and simplification, and the banking sector is no different. Judging by key metrics, the EU banking sector is performing well, and importantly, it is profitable and resilient. That was clearly spelled out in the previous panel. Capital and liquidity buffers are strong, and banks have built resolution buffers and became more resolvable in case of crisis. This is not just truth on paper. Recent crises outside the EU have tested our banks, and they have proved their strength. So what do we mean when we say the sector is not competitive enough? Ultimately, it comes down to scale, to your point. It comes down to scale because it does so in two fronts. Internally, our EU banking market remains too fragmented, limiting the ability to operate and compete seamlessly across borders, which also impacts our external position, as our banks often lack the scale or the actual size needed to compete globally. Scale remains a structural challenge, especially when compared to American banks. This is reflected in lower valuations, but also in higher costs and a weaker global positioning. Europe's key constraint is that the single market remains fragmented across national borders. But this is not to say that reducing fragmentation would mean fewer or only large banks in the EU. We need a diverse range of banks. Small and medium-sized banks provide an important service for many European citizens and businesses, but we do need to see some bigger European banks, a handful to a handful. Let's leave it at some, not too many. But we need to see these bigger European banks that can genuinely compete at the international level in key markets, including investment banking, market-based finance, and digital financial services. And what would a competitive banking sector look like in the EU? In my view, it must be, above all, resilient. But it must also be efficient, innovative, and capable of allocating capital where it is most productive, supporting investment, enabling innovation, and financing the growth of new and expanding firms. It should continue delivering high-quality financial services to households and businesses at low cost. In recent weeks, we have gathered extensive feedback from stakeholders through our consultation on EU bank competitiveness, with way over 200 contributions from public authorities, supervisors, industry participants, and citizens across Europe. This input will inform our forthcoming report on the state of the banking system in the single market. My services are hard at work to get this over the line before the summer. The date is July 15th. We will then prepare for a banking package for the first quarter of 2027. Without preempting the outcome, one conclusion is already clear. We need to be ambitious. To achieve a truly competitive and integrated banking market, including a completed banking union in the EU, just as in our capital markets, we must make it easier for banks to operate across borders. That means reducing unnecessary complexity of our requirements and of the banking framework, as well as addressing fragmentation and enabling a more seamless single market. Maintaining the status quo is not an option if we are serious about funding a competitive EU economy. Because if we want to achieve fundamentally different outcomes, we must take fundamentally different decisions. And this is to your point, it's not tweaking at the margins. That will not do it. Nothing is off the table, and we need to examine everything, including our microprudential, macroprudential, and resolution requirements, and how they interact with one another before drawing final conclusions. At the same time, internationally agreed standards are less aligned than we would like, with jurisdictions tailoring their implementation of international standards to the local characteristics of their banking sector. We will be equally attentive to the specific features of the European system as we shape our approach, and we will firmly safeguard a level playing field and ensure that EU banks are not placed at a disadvantage. Ladies and gentlemen, competitiveness and stability must go hand in hand, and it is our responsibility to create a more competitive banking landscape without compromising on the resilience of the system that took so long to achieve. The strong interest in financial integration, both from industry and politically, everyone supports the SIU, demonstrates clearly that a more integrated European financial services sector will benefit all participants in the financing ecosystem. Market participants stand to gain from deeper liquidity, greater scale, and more efficient capital allocation. Companies from improved access to diverse and competitive sources of financing, and citizens from broader access to innovative financial services and products at low cost. I would add that politicians also benefit because they would get more votes for having made the right decisions. So, the one market, One Europe, One Market roadmap agreed by all EU institutions 2 weeks ago sets the stage to finalize our work in good time. I am looking forward to working with colleagues across the institutions to get the SIU proposals over the line by the end of this year so that we can see the impact of the SIU reflected in strength and integration of the financial system in years to come. Thank you.
Okay, we have 6 minutes and 20 seconds for Q&A.
Right. Okay.
Please, who wants to start? Who wants to break the ice? Well, you actually, I don't know if you remember the question that you got before you took the stage, but does anyone have a question? Philippe? We have people online as well who are sending in questions, and Philippe is
yes, I guess
keeping a track of them.
Excuse me, is one question that wants to have more detail on how the market integration and supervision package actually contributes to market integration. I guess is the voter perspective, how that can, how you can explain that.
Okay. Given that we have less than 5.5 minutes, I'll go for the short
I think you have a
answer.
few more minutes.
Okay, so this is about eliminating the barriers. It's about making clear that delivering for Europe is no longer about us competing among ourselves. That's not the game we are playing anymore, or at least it shouldn't be. The game we are playing now is Europe competing with other major economic integrated blocs. And for that, we need to act more as one. So we need to remove the barriers. The market integration and supervision package is about removing the barriers that will allow us to have capital markets which have the scale, the depth, the liquidity that will allow every investor and every business in Europe to have exactly the same opportunities. And especially if they have to go cross-border, that they don't go cross-Atlantic, which is what's happening today. This is particularly important for the scale-ups, that they have the opportunity to grow here. It's essentially the same problem of scale. And there is one fundamental point. There is no such thing as big member states. We're all small. Some know it. Some are still struggling with the notion. But we are all small for the scale of the challenges we are facing. And that is basically what the market integration supervision package tries to bring about, is removal of those barriers when it comes to market infrastructure and supervisory architecture of capital markets.
Okay, who's next? Yes, Ignacio.
It's a very nice program. What type of response do you expect from national politicians? And how do you plan to approach the reaction and possibly the opposition of national politicians to this program?
Well, on the market integration and supervision package, I have the support of the European Parliament, or at least so I like to believe, but I think I do. And when it comes to the Council, we are already discussing this actively because we have tabled the proposals in December. And there are some opposing firmly, especially the main issue here is central supervision, is the change in the supervisory architecture, who supervises centrally, what stays at the national level. That's where we have the major political debate, I would say. I think that there is clearly a supporting majority, clearly with a preference for watering down our level of ambition. But we are still discussing, so I'm still hopeful that we can deliver something really meaningful, because again, repeating what I said, this is not achievable with small tweaks and incremental improvements. It's not going to work like that. We don't have the luxury of time anymore. because the gaps we are seeing in terms of our competitiveness, of our productivity, if we wait for too long, the gap will become too wide and we will not be able to recover. So the time is now.
Okay, Ignacio, satisfied? Okay, I thought I see, yeah, there's a hand there, please.
Well, thank you, Commissioner. I couldn't agree more, basically, with everything you said. But if I take on the point that indeed we have to realize we are all small, being small also doesn't allow us as sovereign to issue big. And there comes the question raised by Mario Draghi in his report about creating the deep enough, liquid enough, common European safe asset. There hasn't been, well, there have been quite a few proposals over the years. The most recent one, probably Olivier Blanchard's, about creating a common European safe asset. It's a difficult one, I appreciate, particularly if we try to avoid any risk sharing, which is no-go between small nations. But how do we approach that? How do we move forward to indeed creating large enough, liquid enough, deep enough, safe sovereign asset, which, well, European sovereign asset, which can be the basis of European money markets and, you know, everything related to having a very deep and liquid capital markets as part of the savings and investment union?
Right. Well, the short and easy answer would be that is not in my portfolio. But I will not try to get away with that. I prefer to use the words that Ignacio was using in the previous panel. There are obstacles in our way we should not keep banging our head against, and we probably should go around. I do have in my mission letter EDIS, so I do have one of those big blocks in front of me, which I will have to find a way to go around. The safe asset is important for the SIU, fully agree, but it is not part of the project, and it is something that will have. And I understand the point that it would be a major game changer. There are plenty of game changers. What I fear is that if we continue to go back to topics where clearly there is no political openness to discuss in any way or shape, that will prevent us from doing all the other things. And even if what we are doing already under the SIU is not enough to deliver the ideal scenario, it can make such a big difference that actually can put us at a different standard going forward. So when I hear this, some of the topics which are not solvable at this stage coming back, my only concern is that people will say, without solving that, there's no point in trying to do the rest. And I think there is a very good point in trying to do the rest, and maybe we can still try and get to that at a later stage. But for now, I have already too much on my plate, so I will not be entering into the safe asset debate.
Unless it happened while I was out of the room, I think it's the first time the topic came up the whole day.
Oh, but it comes when I'm
yeah, no, I'm sure.
Comes up all the time to me.
Maybe we have time for 2 more questions. Philippe, you have one?
There's one from the online audience on your opinion on the SIU potential of EU Inc. 28th regime. Your expectation, I guess.
EU Inc.
Yeah. Well, okay. I think that the proposal now has to be, or the question has to be addressed to the co-legislators, because the proposal has been tabled and adopted by the Commission, the EU Inc. proposal. The idea is to have a common corporate regime for these companies with the status of EU Inc. that would actually facilitate them to be operating in any of the 27 jurisdictions. Now, it really depends on the co-legislators whether they will preserve the ambition of the proposal or if they will water it down. And it is because the Commission has this very, very strong power of tabling proposals. then it's for the co-legislator to actually decide what hits the ground. It's not for us anymore, even if we help in the process. So the 28th regime proposal, the Ewing proposal, has been tabled, has been adopted by the Commission. Now, both Council and Parliament are looking into it to have their positions, and then there will be an engagement in trilogues. I think that on the One Europe, One Market roadmap, the intention is to have this agreed by year end. So we shouldn't have to wait that long to see where it lands, actually. But it's a very good step in the right direction, I would say, to also help reduce the fragmentation, and especially relevant for not for the startups who want to be scale-ups, who want to grow and need to be able to explore other markets across the EU, also having resources in human resources coming from other EU member states. This could help.
I mean, we like it too. We have something in our report on this also. One last one. Yes. I can't see you.
I can stand up. So my name is Julia Simon. I'm from Finance Watch. I have a question about striking the balance between getting to have the big European champions that we need for big things, but also promoting the diversity of the banking landscape and dealing with the smaller banks. So what is your current thinking, let's say, on the measures to strike that balance? Because we know that at the local level, there is little cross-border activities actually, and local economies are mostly served by those small banks who are actually asking for more proportionality towards them, because they are already struggling in the competition with the big ones who use IRB approaches. They are better placed to offer competitive funding. So we probably do not want them to be out of the scene. We want to keep them. At the same time, we want more integration. So how do you see the measures to resolve or strike the balance here? Thank you.
Thank you, Julia. Good to see you. Well, I think that from a regulatory point of view, we should not decide whether banks should be big or small. We should make sure that there are no regulatory impediments for them to reach the size that makes sense for their business model. So if their business model is about being small and that's what makes sense, regulation should not be overburdening them, and that's the proportionality debate. But if they want to really be big, go for a more universal banking, enter into the CEBO, corporate and investment banking space, then regulation should also not stand in the way, if this makes sense from a business case. So our intention is not to in any way have a negative impact on the diversity of the banking sector. It's allowing the banking models to go where they think it makes sense from a business perspective. And that is the proportionality debate. That's what we are assessing, because I think, as was relatively clear from the previous discussion, there are different ways to address that. You can have the same set of rules applied proportionally, like Basel III to the whole banking system, which is the approach we have opted for here in the EU, at least for now. And there is the American approach, where you have a two-tier system. You have Basel III for big banks with the adaptations they are proposing, and then you have the rest out. They both have pros and cons. Both are ways of delivering on proportionality. I would, however, highlight, because of something, or maybe the way you phrased it, because you said, how can they handle when there are other banks who are more competitive and get more competitive funding? Whatever the way, the model that banks choose, they should be competitive, because it's not for the citizens or the companies they serve to pay a higher price because their size does not allow them to be more competitive. I'm sure that's not what you meant, but it's kind of the idea that it brought to mind. Whatever size they choose to have, they must be competitive in the sense that they must be able to offer good services to their clients at a price which is in itself competitive. Because if not, they will be run out of the market by the competition. And competition is a good and healthy thing that we want to preserve. We just don't want that competition to be done through regulatory means, because that's not the role of regulation. Regulation is to frame the activity, make sure everyone complies, financial stability is guaranteed, and then banks within those rules can choose whatever fits best their business model and their own ambitions and their own client base, if I can put it like that.
Commissioner, I built up expectations. I think you exceeded them. Thank you very much.
Thank you very much, John. Thank you. Oh, God.
There's one more. This is the, we had promised that we would show some of the findings from the survey that some of you participated in. So just a few closing remarks. So, I mean, first of all, thanks a lot to all of you, both those who are here with us in person and those who joined online. I think your engagement throughout the day has made this event genuinely meaningful, and it's been great to reconnect with some old friends. Allow me, if I may, to highlight 3 key takeaways from the discussions. On CU implementation, I'm going to think about this acronym differently from now on. There is a broad consensus on the urgency of fully and swiftly implementing the SIU and completing the banking union. And I think the direction is clear and the need for decisive action is widely shared. On the topic of retail investor participation, as was underscored in our report and in the one of the Commission, strengthening retail investor engagement and advancing pension fund development are essential pillars. So this morning's panel, I think, offered rich insights with the call to improve financial literacy, emerging as a particularly strong theme, and it inspired me with an idea for writing something about compound interest on social media this weekend. We were reminded about the importance of compound interest and when we learn it. European banking scale. Banks remain the indispensable bridge between savings and investment. For Europe to compete globally, it must nurture a small number of large, truly cross-border institutions with scale, capacity and ambition to operate as European rather than as national champions. And I think if we were to, what was the word of the day? I think the word of the day would have been scale. Scale in banking, scale in capital markets, and scale in ambition. Now, as I promised, I would like to share some of the results of our poll. You recall that we asked participants to prioritize 4 initiatives within the Savings and Investments Union agenda. So they were strengthening retail investor participation and deepening investment and financing channels, enhancing supervisory efficiency, and supporting a more competitive banking system, and then to identify within each the most important policy measure. So we've got some of the results there on the screen. I mean, I think I only got to very briefly because they are being accumulated real time. But I found this one a bit striking in the sense that there is not really a consent. No, the previous one, Philippe. I mean, there's not really a consensus there, is there? I mean, it's kind of everything, everything. So, I mean, this is maybe, I don't know if this is an issue in itself, figuring out how to prioritize. So then we can go then, and we just have 4 more slides going for each of those policy domains very, very quickly, and what people thought are the most important. I think we have a bit more clarity within the domains. So here we have citizens, retail savings, and we have RIS, financial literacy, and SIAs. Savings and investment accounts are the clear winner there. And I mean, I don't know, the next 2 are I would say that they're arguably pretty close. Go to the next one. Supplementary pensions, again, we've got two that are completely neck and neck, pension tracking systems and PEP regulation review, both 44%, and then IORP2 directive review. I don't know whether one might have needed specialized knowledge to, tick the box there, but so anyway, that's where we've got. Then on investment and finance, next one, did I skip one? Investment and finance should be the next one, no? That's what I have in mind. Oh yeah, okay, it's ordered now differently. Yeah, okay, well there's a clear winner again. My slides are updating real time. Banking competitiveness measures in pole position on that one. And then finally, on supervision and market integration, I think the message on deposit insurance was heard today during the conference. So I think that is maybe a compliment to the Vice President's speech and the discussion at the beginning of the conference. So I think that's basically all I have to say. And just to say thanks a lot to the speakers for all the effort. We know how much work is involved, the amount of preparation and so on. Without you, the day would not have been the day that it was. So thank you very much, and to the Commissioner.